Hi everyone, how are you? I hope all of you are doing really good. So welcome to the session and we are going to start with a discussion on the PVQs. First up, we have the PVQ of May 2024 attempt. PVQ of May 24 attempt. Financial management PVQ we are going to discuss, right? So let's start. Now in May 24 attempt, we were not having the MCQs. I mean, in the exam, the MCQs were asked, but the ICI didn't give it in the suggested answers that what were the MCQs, and the students were not allowed to carry the answer sheets. Okay. So we have only the descriptive part in May 24. From September 24 onwards, the MCQs were also provided. Booklets were, the students were allowed to carry the booklets with them. So let's start with question number 1, descriptive. I will give you the hints that how the question is to be solved, because the purpose of solving these PVQs is that you get an idea that how to solve the question. That is really important, sir, right? So I will give you the hints, and after that you people can try it once that okay, this is hint, this is how we have to deal with the question. That is going to be the most important thing. Okay, fine, sir. So first question we have is Theme Limited provides you the following information. 1 second. Okay. 12.5% debt is given of 45 lakh rupees. Debt to equity ratio is 1.5:1. So return on shareholders fund is 54%. Operating ratio is given 85%. Ratio of operating expenses to cost of goods sold. Now, what is this operating ratio? This is operating cost ratio. This is nothing but your operating cost ratio, sir. Right? 85%. Then operating expenses to cost of goods sold is given, tax rate is given, fixed assets are given, and current ratio is given. You are required to calculate interest coverage ratio. What is interest coverage ratio? Sir, interest coverage ratio tells us that whatever the interest is to be paid, whatever the interest is to be paid on debt, what are the profits which are available for the interest coverage? That whether we have the sufficient profits. Which profits, sir? Operating profits. Or what is the formula? That is EBIT divided by interest on debt. Right? EBIT is what? EBIT is nothing but your operating profit, sir. Right? EBIT is nothing but your operating profits. Now, gross profit ratio, simple, sir. Gross profit divided by sales into 100 and current assets, he says you need to calculate. Okay, fine. So how can we start? These kind of questions I have told you that whenever there are certain ratios which are given, certain information given, and there are absolute values also, start with the absolute values. What are the absolute values? One is debt, another one is fixed assets which is given to you. Can you start with the fixed assets? Do you have any ratio in which you can start with the fixed assets, sir? No. Right? That means we will have to start with the debt. Now, what is there in case of debt? What is the interest on this debt? What is the interest amount? That is 45 lakhs, 12.5%. That comes to 5 lakh 62,500. This is the interest amount. Clear? Now, what we need? We need EBIT, sir. How can we calculate EBIT? See, debt to equity ratio is given. Where can we use this 45 lakhs? Sir, debt to equity ratio is given 1.5:1, right? So debt to equity ratio here means debt divided by equity. Debt divided by equity is given as 1.5:1. Now debt you are having, sir. Debt is having of 45 lakhs. Right, divided by 1.5, that will be equal to your equity. So what it will be? 45 lakhs divided by 1.5. So equity is 30 lakhs. Right, equity is 30 lakhs. Next, you are given return on shareholders fund. Sir, equity is what? Equity is nothing but your shareholders funds only. Remember the lectures where I have given the terminologies when we discussed about this debt ratio, debt equity ratio, debt ratio. I have given all those terminologies. I have given all the different names to the terminologies. Equity, net worth, shareholders fund. There is a difference between shareholders fund and the equity shareholders fund. Everything I have explained in detail. Yes. So what is given, sir? Return on shareholders fund is 54%. What is that return means? Return means the earnings after taxes, because that is the amount that is left for equity shareholders, right? For preference shareholders, for equity shareholders, for reserves, what is the amount, that is what is the return? Everything is to be paid out of the earnings after taxes. Preference dividend to be paid from EAT, reserves to be created from EAT, equity shareholders to be paid from EAT. So what is the return here for shareholders fund? EAT, right? That means the EAT, can I say that EAT divided by this equity of 30 lakhs, this is equal to 54%, right? So what will be your earnings after taxes? That will be 30 lakhs into 54%, right? That comes to 16 lakh 20,000, right? 16 lakh 20,000. Now tax rate is given. How much, sir? Tax rate is 25%. Can you calculate the earnings before taxes? Can you calculate the earnings before taxes? 25%. Yes, sir. What will be your earnings before taxes? That will be 16 lakh 20,000 divided by 75%. That comes to 21 lakh 60,000. Sir, is it the cover for interest? No, sir, not yet. We need to calculate EBIT. What will I do? I will add interest in this. I will add back interest in this. What is the interest amount? 5,62,500. 5,62,500. So from here you will get your EBIT, right? 5,62,500, that is 27,22,500. This is your EBIT. Now you can calculate this interest coverage ratio, that is 27,22,500. 27,22,500 divided by interest on debt of 5,62,500. So it is 4.84 times. It will be in times, right? It will be in times coverage ratio. Clear? Next they are asking for is gross profit ratio. Now for that, what is given, sir? Operating ratio is given. Sir, what can we calculate? Fixed assets and all those things are given to you, right? Now operating ratio is given 85%. That means my operating cost is 85% of sales. Can I say that my operating cost is equal to 85% of sales? Yes, sir. If my operating cost is 85%, can you tell me what will be my operating profit from here? What will be my operating profit? Sir, if the cost is 85%, my profit will be 15% of sales, isn't it? Now what is operating profit? Operating profit is nothing but your EBIT. EBIT is 15% of sales, right? The value of EBIT do you have? Yes, sir. The EBIT value we have, sir, 27 lakh. So 27 lakh 22,500 divided by 15%, I will get the sales, right? 27 lakh 22,500 divided by 15%. So I am getting a sales of how much, sir? 1 crore 81 lakh 50,000. So sales here is 1 crore 81 lakh 50,000. Now next, what can we calculate, sir? Sales minus operating profit will give me the operating cost, or directly operating cost is how much? So what will be my operating cost? That will be 85% of 1 crore 81 lakh 50,000. This will come to 1 crore 54 lakh 27,500. Now there is another ratio that is given, which is operating expenses to cost of goods sold, right? Operating expenses to cost of goods sold. So operating expenses is this much, sir, which we have calculated, right? So operating cost or operating expenses, right, divided by COGS is equal to how much, sir? It is given as 2 is to 6, 1 by 3. It is given as 2 is to 6, or I have taken 1 by 3, sir. That's fine. Right, now operating cost I am having, sir. I'm having operating cost of 1 crore 54 lakhs 27,500 multiplied by 3. That will give me COGS, isn't it? So that will be, COGS will be how much, sir? My COGS will be 1 crore 54 lakh 27,500 into 3. Oh, this is too much, sir. I guess some mistake. Wait, sir, wait. We have committed a mistake here, sir. We have committed a mistake here. It is not operating cost. It is operating expenses which is given to us. Wait a minute. Sorry, there is a mistake. It is the operating expenses ratio which is given to us. Right. So COGS, from here we can say one thing, that operating expenses is equal to COGS divided by 3. Right. And we know that what is operating cost. There is a difference between operating cost and operating expenses. Operating cost is COGS plus operating expenses. So this was the mistake that we committed. So here 1 crore 54 lakh 27,500 is equal to what? Is equal to COGS plus operating expenses. I'm writing it as COGS divided by 3. So from here you have to calculate the value of COGS, that you will get as 1 crore 15 lakh 70,625. Right? This is the value that you will get, sir. Yes, 1 crore 15 lakh 70,625. Right? This is COGS. Now you have the sales. You have sales value. Fine, sir. We have sales value here. We have COGS here. So we can calculate gross profit and we can calculate the gross profit ratio. Now this you can do it on your own, sir. Right? This you can do it on your own. Isn't it? Okay, fine, sir. Now what about the current asset? Now for current asset, current ratio is given to you 1.8:1. Right, this is given to you as current assets divided by current liabilities is equal to 1.8:1. I can write it as current asset is equal to 1.8 CL. Right, now we have to take the total of asset side and liability side. What will be there on the liability side? We will have the debt, we will have the equity. Value of equity we have calculated, sir. Where, sir? 30 lakhs. Right, on the liability side, what we know is, we know that current assets is equal to current liabilities. Current assets will be what? Fixed assets plus, total asset is equal to total liabilities. I'm talking about the liability side. I'm saying total asset is equal to total liabilities. Total asset will be what? Fixed assets plus the current asset. So 39 lakhs plus current assets is equal to total liabilities will be what? Debt of 45 lakhs. Yes, sir. Plus equity of 30 lakhs. Yes, sir. Plus any other thing, sir? Current liability. Yes, sir. Current liability. Now what we will do? We will substitute this 1.8 CL here. We can calculate the value of current liabilities. From there we will get the value of current assets. Right? So your current asset is equal to current liabilities. From there you will get the value. Substitute this 1.8 CL in place of this. Then all the equation will be in the current liabilities. You will get the value of current liabilities. From there you can calculate the value of current assets. Right? So this is question number 1, A part. Coming to question number B. Alpha Limited has provided the following information: equity share capital 25,000 shares at rupees 100 per share. 15% debentures, 10,000 debentures at 750 per debenture. Okay. Sales is 50 lakh units at 20 per unit. Variable cost is 12.5 per unit. Fixed cost is 175 lakhs. Okay, sir. Due to the recent policy changes and the entry of the foreign competitors in the sector, Alpha Limited expect the sales may decline by 15 to 20%. However, the selling price and other cost will remain the same. Corporate taxes will continue at 20%. You are required to calculate the decrease in earnings per share degree of operating leverage and financial leverage separately if the sales are declined by 15% and 20%. Right? So you have to consider two cases. One, the sales quantity is going to decline by 15%. Then 20%, calculate the decrease in earnings. You have to calculate the operating leverage and financial leverage. Right? Is that really difficult, sir? Is that really difficult? I don't think so. See, one way of doing this question is prepare the income statement. Sale in units existing 50 lakhs, then declined by 15%, declined by 20%. Selling price per unit, no change in that. Variable cost per unit, no change in that. Contribution will remain same, sir. Right? Then contribution, total contribution, fixed expenses at all the levels, fixed expenses are going to remain fixed. They are not going to change. EBIT minus debenture interest, EBT less tax profit after taxes divided by number of equity shares, you will get EPS. Then calculate the change in EPS. The change in EPS, decrease in EPS you can calculate, sir. Right? And here also the decrease in EPS you can calculate. Clear? Fine, sir. Then you have to calculate what is the operating leverage at both the levels, right? And the financial leverage at both the levels. Simple, sir. Prepare the income statement incorporating the decline in the sales. There is nothing difficult. Selling price is not going to change. Variable cost per unit is not going to change. Contribution per unit is going to remain same, right? So fixed expenses are going to remain same at any levels. You just have to prepare the statement, find out what is the decrease in the EPS. You have to calculate it in the rupee terms also and in percentage also. In rupee terms also and in percentage also. Then you can calculate operating leverage, contribution by EBIT, or degree of operating leverage, percentage change in EBIT divided by percentage change in sales. Both way it is correct, sir. That is totally your choice, right? You can use any formula that will give you the correct answer, right? That will give you the correct answer. Do it by any formula. It is not necessary that you have to do it by both the formulas. Clear? So this was B part on the leverages. Okay, fine, sir. Leverages done. Easy question, but good question on leverages, where you have to prepare the income statement under the three options: existing, 15% decline, then 20% decline. Coming to the next one, C part, factoring. The following is the sales information in respect of Bright Limited. Annual sales is 90% on credit, 7 crore 50 lakhs. So 7 crore 50 lakhs, 90% of that means 6 crore 75 lakhs. 6 crore 75 lakhs is your credit sales. Credit period is 45 days. Average collection period is 70 days. Bad debts is 0.75%. Credit administration cost, out of which 2/5 is avoidable, 18,60,000. 18,60,000 into 2 divided by 5, that is 7,44,000 is avoidable. Fine. A factor firm has offered to manage the company's debtors on the non-recourse basis at a service charge of 2%. The factor agrees to grant an advance against the debtors at an interest rate of 14% after withholding 20% as reserve. The payment period guaranteed by the factor is 45 days. Otherwise, the collection period is 70 days. The factor says, I will collect the money in 45 days, sir. Don't worry. Right? The cost of capital of the company is 12.5%. One-time redundancy payment of 50,000 is required to be made. Calculate the effective cost of factoring to the company. Assume 360 days in a year. Now, whenever there is a factoring question, what do you have to see? You have to see what is the savings and what is the cost that will be incurred. So, whenever we are talking about the factoring, sir, in factoring, what we have to see? In factoring, we have to see what will be the savings and what will be the cost that will be incurred. The savings here will be what? The one of the savings will be this bad debt saving, right? 0.75%. One of the savings here will be bad debt, sir, right? So how much of the bad debts you are going to save? The bad debts will be 0.75% of the credit sale. Credit sale is 6 crore 75 lakhs. This you have to be careful. Right? So 6 crore 75 lakhs, 0.75%. That comes to 5 lakh 6,250. Another one is admin cost saved. Admin cost saved. How much, sir? The avoidable part only 7,44,000. Sir, any other savings is there? Now there is very important point here. The average collection period for the company was 70 days. Now this factor says I will collect the money in 45 days. Earlier the money was blocked for 70 days. Now the money will be blocked for only 45 days. There is savings in the opportunity cost for the remaining days. For 25 days, there will be savings in the opportunity cost, right? So here we will take savings in opportunity cost. How much, sir? How much is the credit sale? 6 crore 75 lakhs multiplied by how many days is the savings? 25 days divided by 360 multiplied by 12.5%. This will be the savings. Wait. That 6 crore 75 lakhs into 25 divided by 360. 12.5%. That comes to 5,85,938. 5,85,938. 937.5. You can round it off to 938 if you want to take it in the absolute figures. That's fine. Now, what will be the cost that will be there? The cost will be a service charge of 2%. Yes, sir. There will be a cost, that is service charge. Service charge. How much, sir? Service charge of 2%, sir. Right. So 2% on the credit sales of 6 crore 75 lakhs. Fine. 6 crore 75 lakhs. 2% of that comes to 13,50,000. So there will be this cost, 13,50,000 will be the service charge. What else will be there, sir? Against interest. Now the factor agrees to grant the interest rate of 14%. This is another cost that will be there after withholding 20%. Now these things need to be calculated, sir. Interest cost. Interest cost at the rate of 14%. How will you calculate this interest cost? Let's try to understand here. How will you calculate interest cost? Sir, what is your credit sales? What is your credit sales? Credit sales is 6 crore 75 lakhs, right? And what is your average level of receivables? Average level of receivables. For how many days it is the investment in receivables, we can say 45 days now, because the factor has agreed for 45 days. That comes to 84,37,500. That means the factor will be managing the receivables of 84,37,500. On that, now interest will be on the advance amount. So first we need to find out what will be the advance amount. On this, the service charge will be there. On this, the service charge will be there at the rate of 2%. Fine, sir. 2% service charge will be there. That is 1,68,750. Then this reserve money will be there. Reserve will be how much? 20% of 84,37,500. Right? That comes to 16,87,500. Now, this will give you the amount available for advance. Amount available for advance. 84,37,500 minus 1,68,750 minus, that comes to 65. Wait. 60, correct. 65,81,250. On this, the interest will be charged. On this amount, the interest will be charged. Interest will be 65,81,250. 14% interest will be charged for how many days? For 45 days, sir. Right? 14% interest into 45 divided by 360. That comes to 1,15,172. Right? So net advance will be how much? Net advance will be 65,81,250 minus 1,15,172. That is 64,66,078. So interest cost. Now this interest cost is for how many days? 45 days. If I want to calculate for the full number, here interest cost will be 1,15,172 into 360 divided by 45. So 1,15,172 into 360 divided by 45, that comes to 9,21,376. Correct. Right. So this will be the cost. Now another cost, any other cost? Yes, sir. Redundancy payment is there. Redundancy payment is there, 50,000. So this will be your total cost that you will have to incur. This will be the total savings that you will have, right? So you have to find out whether the cost is more or whether what is the total savings, sir? 5,06,250 plus 7,44,000 plus 5,85,938. Total savings is 18,36,188. What is the total cost? That is 13,50,000 plus 9,21,000. Wait. 13,50,000 plus 9,21,376 plus 50,000. That comes to 23,21,376. Now, what the question is asking? Question is asking for the effective cost of factoring to the company. Effective cost means what is the extra cost that you have to incur minus 18,36,188. The cost that you have to incur is 4,85,188. For effective cost, what is there? This is the cost that the company has to incur for using this amount. So what is the percentage cost? Divided by 64,66,078 into 100 divided by 64,66,078 into 100. That comes to 7.5%. So this is the effective cost of factoring, what they are asking. Right? So this is the complete solution for factoring, where you have to calculate what will be the savings, what will be the cost, and accordingly you have to solve this. Clear? Complete factoring solution. Right? So effective cost of factoring means that to use the money that you will receive from factor, the money that you will receive from factor is this one, 64,66,078. To use this money, what is the cost that the company will have to bear? The cost that the company will have to bear is this one, 5,85,188. Right? Okay, so good one, sir. C part done. Question number 1, we are done with all the 3 parts. You can verify the answers, right? Okay, let's move to question number 2. Cost of capital. Great, sir. Cost of capital. The capital structure of Shine Limited as on 31st of March 2024 is as under. Equity share capital of 10 each, 45 lakhs. 15% preference share capital of rupees 100 each, 36 lakh. Retained earnings 32 lakh. 13% convertible debentures of 100 each, 67 lakhs. 11% term loan is 20 lakhs, and total 2 crores of the capital structure they are having. The company issued 13% convertible debentures of rupees 100 each on 1st of April 2023 with a maturity period of 6 years. At maturity, the debenture holders will have the option to convert the debentures into equity shares of the company in the ratio 1:4. That is 4 shares for every 1 debenture. The market price of the equity share is 25 each as on 31st of March 2024, and the growth rate is 6% per annum. Now, what does it mean, sir? just try to understand regarding the debentures, right? What is given regarding the debentures? Just try to understand here, sir. Wait. I'll prepare a timeline and give you that flow. Now, he says the debentures are issued. When are the debentures getting issued? The dates are going to be important. The debentures are issued on 1/4/2023. Okay, sir. The debentures are issued on 1st of April 23 for 6 years. 1, 2, 3, 4, 5 and 6 years. Right. Now, there is another important date, that is 31st of March 24. Here the person will have an option either to get the debenture back or to get equity shares, right? Or to get equity shares. Now, we need to find out what will be the value of equity share here. If the person gets a debenture, he will get 100 rupees. If he gets equity share, we need to find out the value of equity share there. The value of equity share is given. The market price is 25 as on 31st of March and growth rate of 6%. So here the market price is 25 rupees. It will grow at 6% every year, right? 6% every year it is going to grow for 5 years. So what will be the value of equity share here? The value will be 25. It will be 53 rupees, I guess. Wait, let me check. It will be somewhere, I guess. No, sir. It will be something else. Wait, for 5 years we have to apply, right? So 25 plus 6%, you will get 26.5 here. Right, plus 6% you will get 28.09 here, plus 6% you will get 29.77 here, plus 6% you will get 31.56 here, plus 6%, okay, you will get here 33.46. This will be the value, 33.46. Now he says for every one debenture 4 shares will be given. So multiplied by 4, what will be the total value? 133.84. 133.84. So when you will calculate KD at the redemption value that you will take is 133.84, the higher of the two. Simple, right? Rest of the question is easy, sir. Preference stock redeemable after 8 years is currently selling at 150 per share. So net proceeds will be 150. Right, redemption value will be 100, sir. If nothing is mentioned, the redemption value is to be taken as 100. The prevailing default risk rate is 6%. Average market risk premium is 8%. Beta is 1.24. This is for KE and KRE. Right, KE and KRE. That will be 6% plus 1.54 into 8%. Now 8% is the risk premium that is already given to you. So do not do 8 minus 6. No, right? 8 into 1.54 plus 6, that comes to 18.32%. The corporate tax rate is 25% and rate of personal tax is 20%. So why the rate of personal tax is given? Why the rate of personal tax? Because for KRE, you can also calculate as KE into 1 minus TP, that is the personal tax rate. This also you can do it for the calculation of KRE. Right, so both ways it is correct. Both the alternatives are correct, sir. Right, preference shares you can calculate. They are asking for equity share capital, preference, convertible debenture, retained earnings and term loan. Term loan will be simple, sir. Whatever is the interest into 1 minus tax, that will be the term loan. Very easy question. The only thing was this convertible part, that you have to calculate the value of equity share at the end of 6 years and find out what will be the redemption value that will be taken for calculation of KD. Right? Now you will be able to solve this question. Second, A part we are done with. B part is on what? B part is on arbitrage process. This is the same question that we have done it in the module illustration number 6 and 7. Right. Capital employed is given, EBIT is given, KE is given 12.5%, then levered company 75,000 debt, 1,25,000 equity, unlevered company nil, 2 lakh of equity. An investor is holding 12% shares in the levered company. Fine, sir. Calculate the increase in the annual earnings of the investor if he switches over his holding from levered to unlevered company. Now it can be done in both the ways. If you look at the solution they have given both the ways. One way is where the investor invests everything that he gets, right? Doesn't want to maintain 12% shareholding. The second option is the investor wants to hold 12% only, right? There he will take a loan where the debt equity ratio is to be maintained. That is really important, sir. Right now, arbitrage process, illustration number 6 and 7 of the module, same question I have explained in detail with the steps. That first thing is prepare the income statement, calculate the value of equity, calculate the value of debt, calculate the value of firm, calculate the debt equity ratio in the levered company. Then first step will be, after that, sell the shares in the levered company, whatever the amount that he will get. Now he wants to invest in the other company. If he is not having the sufficient funds to be invested, he will take a bank loan in the personal capacity in such a ratio, in such a way that debt equity ratio is maintained. All the steps I have given, right? So this arbitrage process, you people will try it on your own. Now this is a very, very, very good thing. If you get arbitrage process, this kind of a question you can easily solve. Hardly it should take for the solution 7 to 8 minutes maximum. There is nothing, no new point in this. If you know the steps of the arbitrage process, which I have already covered in the lectures in detail, right, you can easily solve it, sir. Coming to question number 3, the last practical question. Capital budgeting. Capital budgeting, sir. Great. Come to this question on capital budgeting. HCP Limited is a leading manufacturer of the railway parts for the passenger coaches and the freight wagons. Due to the high wastage of material and the quality issues in production, the general manager of the company is considering the replacement of machine A with a new CNC machine B. Machine A has a book value of 4,80,000 and the remaining economic life of 6 years. So right now machine A is having a book value of 4,80,000 and remaining life of 6 years. It could be sold now at rupees 1,80,000 and zero salvage value at the end of 6th year. Right now it can have a salvage value of 1,80,000. The purchase price of machine B is rupees 24 lakhs with the economic life of 6 years. It will require 1,40,000 for installation, 60,000 for testing. Subsidy of 15% on the purchase price of the machine B will be received from the government at the end of the first year. Salvage value at the end of the 6th year will be 3,20,000. Okay, fine, sir. The general manager estimates that the annual savings due to the installation of machine B include a reduction of 3 skilled workers with the annual salaries of 1,68,000 each, 4,80,000 from the reduced wastage of materials and the defectives, and 3,50,000 from the loss in the sales due to delay in the execution of purchase orders. So this all will be what? The savings. This will be taken in the statement of CFAT. Operation of machine B will require the services of a trained technician with an annual salary of rupees 3,90,000 and annual operation and maintenance cost will increase by 1,54,000. The company's tax rate is 30%, required rate of return is 14%. The company follows the straight line method of depreciation. Ignore tax on savings on the loss due to sale of existing machine. The present value factors are given. Calculate the net present value, profitability index, and advise the company for replacement decision. Also calculate the discounted payback period. So I will prepare what? I will give you a timeline of this. Okay, sir. As we have been doing the capital budgeting questions, we always prepare a timeline, sir, isn't it? So the same thing we are going to follow here also. For 6 years, we are going to prepare a timeline. Okay, this is your 0 period. This is your first period, second period, third period, fourth, fifth and sixth period. So I'm going to prepare a timeline. What all things will be there at 0 period? The first and the foremost thing is This question is to be solved by incremental approach. Incremental approach. Right? You cannot solve the NPV separately for old and new machine. Right? So you have to solve it by the incremental approach. When we have a replacement decision, replacing the old machinery with the new machinery, we do not have all the data relating to the old machinery to calculate NPV. Right? For old machinery, what we have? Do you have the original value of old machinery? No, sir. Do you have any cash inflows related to the old machinery? No, sir. We only have that if we go for the new machinery, what will be the savings? What will be the incremental or the additional cost? So this question is to be solved by incremental approach. This is a replacement decision question of capital budgeting. Now at zero period, what will be there, sir? At zero period, first thing will be the cost of new machinery, cash outflow, 24 lakhs. Right? Then 1,80,000 will be the scrap value of the old machinery, because right now it is having a scrap value of 1,80,000. So it will be a cash inflow of 1,80,000. Fine, sir. After that, then we have the installation expenses of 1,40,000. Yes, sir. Cash outflow 1,40,000 installation expenses. Then another 60,000 for testing. Again a cash outflow, that is 60,000 is the testing cost. Any other thing? Sir, subsidy. Salvage value at the end of 6th year will be 3,20,000. So here we will have a salvage value of new machinery. New machinery, that will be 3,20,000. Right? Any other transaction taking place at zero period? No, sir. I don't think so. So what will be the net value, net cash outflows at zero period? 24 lakhs plus 1,40,000 plus 60,000 minus 1,80,000. That comes to 24 lakhs 20,000. 24 lakhs 20,000. That will be at zero period. Now regarding the subsidy, sir. Subsidy, he says it will be 15% on the purchase price and it will be received at the end of the first year. So subsidy will be received here, sir. Here you will get subsidy. How much, sir? Subsidy will be 15% of purchase price. Purchase price is 24 lakhs. Of this you will get 15% subsidy, that is 3,60,000. This will be at the end of the first year. It will reduce your cash outflows, right? Then what else is there? Now for the statement of CFAT, what will you take, sir? For the statement of CFAT, what will you take? There will be the savings. For all the years, it is going to be same. For all the years, it is going to be same. Statement of CFAT. Statement of CFAT. So first you will take all the savings here. Savings. Which all savings will be there? It is given now. The savings will be how much, sir? 1,68,000 into 3. Skilled workers, right? Savings will be how much? 1,68,000 multiplied by 3. That is 5,04,000. One saving will be there. After that, 4,80,000 from the reduced wastage of material. 4,80,000 will be there. Plus what else will be there? 3,50,000 from the loss in the sale. Okay, 3,50,000. So this will be the total savings. How much? 5,04,000 plus 4,80,000 plus 3,50,000. That is 13,34,000. This will be the total savings minus the cost. What is the additional cost that we will have to incur? For that, services of a train, 3,90,000 and 1,54,000. Right? 3,90,000 minus cost will be how much? 3,90,000 and 1 lakh plus 1,54,000. Right? 3,90,000 90,000 plus 1,54,000, that comes to 5,44,000. Sir, anything else to be taken? Yes, sir. One more thing that we have to take, that is incremental depreciation. Oh, sir, we will have to subtract here one more thing, that is incremental depreciation. How will you calculate incremental depreciation? Sir, for the old machine, we have two things. One is for the old machinery. For the old machinery, the current value is 4,80,000. Salvage value of 0 at the end of 6 years divided by 6. So 4,80,000 divided by 6, that is 80,000. This is the depreciation every year if we continue with the old machinery, right? For the new machinery, how will you calculate depreciation? What is the value of the new machinery? That is 24 lakhs. Are we going to add testing cost? Yes, sir. It is going to be capitalized. Add 60,000 testing cost. 1,40,000 is training, I guess. Installation cost, right? Minus subsidy of 3,60,000 minus salvage value of 3,20,000 divided by 6 years. This will give you the new machinery depreciation. Plus 1,40,000 plus 60,000 minus 3,60,000 minus 3,20,000. That is 19,20,000 divided by 6. 3,20,000 is the value of depreciation for new machinery. So what is the incremental depreciation? What is the incremental depreciation? That will be 2,40,000. Clear? 2,40,000 will be your incremental depreciation. 2,40,000. So from here you will get earnings before taxes 13,34,000 minus 5,44,000 minus 2,40,000, that is 5,50,000. Okay, minus tax on this. What is the tax value, sir? Tax at the rate of 30%. 1,65,000. So you will get earnings after taxes, that is 3,85,000. In this 3,85,000, add back depreciation of 2,40,000. You will get what? You will get incremental CFAT, 6,25,000. Now you can solve it, right? You have to take incremental CFAT at 0 period first year. You have to take the cash flows and the salvage value of new machinery. Now you can calculate NPV. All the workings I have done. Now you can prepare a statement of NPV and calculate NPV. From there you can calculate PI. PI is simple, sir. Sum of present value of cash inflows by sum of present value of cash outflows. From the NPV statement only you will get that, isn't it? Now discounted payback period also you can calculate. You have the present value of all this cash flows, right? For the CFAT you will have all the present value of the cash flows. Then what you can do is, for the payback period, you will calculate present values. After present values, you will calculate the cumulative present values. And from there, you will calculate the discounted payback period. Clear? 6,25,000, 6,25,000, 6,25,000. In the last year, you have to be careful. In the last year, you have to take 6,25,000 plus the scrap value of 3,20,000. So total value will be 9,45,000 in the last year. For discounted payback period, calculate the present values and then calculate the cumulative values, right? So a very good question on capital budgeting, sir. Easy. It is not at all difficult. The only thing is you need to identify that it is to be done by incremental approach, right? So question number 3, A part done. Question number 3, B part. Vista Limited's retained earnings per share for the year ending 31st of March 2023 being 40% is 3.6 per share. It is the retained earnings, right? The company is foreseeing a growth rate of 10% per annum in the next 2 years. After that, the growth rate is expected to stabilize at 8% per annum. The company will maintain the existing payout ratio. If the investor's required rate of return is 15%, calculate the intrinsic value per share as of date using the dividend discount model. Now, what does the question says? This type of a question is already there in the module. Already there in the module, sir. He says, according to the question, what is there? Let's see. 31st of March 23, or I can say 1st of April 23. Here the retained earnings are given to you 3.6 and it is 40%. So can you tell me what will be your EPS? It is 3.6. EPS will be 9 rupees. So can you tell me what will be the dividend? If 40% you are retaining out of EPS, that means 60% you are distributing, right? So 60%, that is 5.4. This 5.4 is what? This is D0. This is D0. Now he says for the first year, for the second year, and after that 3, 4, 5 up till this. For the first year, growth rate is how much? 10%. Here also 10%, and after that it is 8%, sir. Right? So here what will be your D1? It will be 5.4 plus 10%. It will be 5.94. Then plus 10%, it will be here D2. It will be 6.534. After that it will be 8%. Now what they are asking is, they are asking you to calculate the intrinsic value here. Intrinsic value. Intrinsic value will be what? It will be the present value. It will be the present value of all future dividends. But sir, the time period is not specified here. This is for the infinite life. This is for infinite life. Then how we can calculate? We can calculate the present value of this. There is no issues in that. Right? Required rate of return is given 15%. We can calculate the present value of this. But what about the dividends here? Can we ignore it? No, sir. What we will do here is, we will apply the growth model here. Now, for this, when we can apply the Gordon's growth model, when the growth is constant, after 2 years, the growth is constant. So can I find out the price of the share at this level? Can I find out the price of the share at this level? Yes, sir. I can find out. What will be the price here? P2. P2 here will be D3 divided by KE minus G. Can I write D3 as D2 into 1 plus growth rate divided by KE minus G? D2 I have 6.534 into 1 plus growth rate is now 0.08. KE is given as 0.15 minus 0.08. Find out the value of P2 from here. Whatever the value of P2 that you get here, find out the present value and add it to this. Add it to the value of intrinsic value. So intrinsic value will be what here? I'll write down this, then you will do the calculations. Intrinsic value will be present value of D1, D1 into present value factor of the first year at 15% plus D2 into present value factor of the second year at 15%, right? And add P2 multiplied by present value factor of the second year at 15%. This total will give you the intrinsic value, right? This will give you the intrinsic value. It is a same question which was there in the module, where we have the variable growth for the first 4 years and thereafter we have the constant growth, right? Same question. Here they have the variable growth for the first 2 years. After that it is going to be a constant growth. So that's all for the May 2024 paper B part done. Then question number 4 is purely theory. You can just go through it once. Now in September 2024, if I talk about the overall paper, it was easy to average. It wasn't that difficult. Simple, straightforward questions were there. Yes. And from May 2024, the ICI allowed to carry the MCQ booklet. So we have the MCQs also. Let's start with the case scenario first. The case scenario 1, it is on investment decisions, or what we call it as capital budgeting. Okay, let's read it. RS Limited is manufacturing and selling the soft drinks in India. The production process involves one important process which increases the shelf life of the soft drinks. Okay. Presently, the machine used for this purpose is an old one, in which the wastage due to the breakage of the glass bottles is considerably high, and due to its limited capacity, the company is not in a position to increase the production. right? So there is an old machine which is there. The production manager has approached the CEO of RS Limited for purchasing an automated machine which will drastically reduce the wastage due to the breakage during the process of increasing the shelf life of the soft drink. So an old machine which is causing the problems of the breakages. Right, so this production manager says, sir, why not buy a new machine? It will reduce the breakages, it will reduce the wastages. See, what is the impact of wastages? It increases your cost. He says, sir, we will be able to save the cost. Okay, let's see. The automated machine will support increase in production. The production manager is confident that the acquisition of the automated machine will be beneficial for the company. Now, this is what? This is a question on replacement decision, the replacement of the old machinery with the new machinery. Other information is as under. With the introduction of the automated machine, the additional sales and related cost over the next 5 years would be as follows. That if you buy this new machinery, what will be the additional number of units that we will be able to sell? What will be the additional cost that will be incurred? So those details are given to us. In year number 1, additional sale units will be, selling price per unit is given, variable manufacturing, selling and distribution cost is given, and additional fixed selling and distribution cost. This is per unit which is given to you. Fine. Next, the cost of acquisition of the automated machine is rupees 5 lakh. Residual value of the automated machine at the end of the life of 5 years is 50,000. Okay. The depreciation on the automated machine will be under the straight line method. So can you tell me what will be the amount of depreciation every year, sir? 5 lakh is the cost of the machinery minus 50,000 scrap value divided by 5 years. So it will be 90,000 rupees per year. Right? This will be depreciation. The product manager has estimated that the cost savings before tax due to the reduction of breakages will be as under. That because we will introduce the new machine, we will be saving some cost on the breakages, and this is before tax. 15,000 in year 1, 15,000, 20,000, 20,000 and 20,000. So this is a saving, and this is what? This is a deemed cash inflow. Right? The machine which is being used at present has zero written down value, and if sold would fetch any amount, an amount of 10,000 only. The cost of capital of the company is 10%. The tax rate applicable is 30%. Ignore capital gain tax. The present value factor of rupee 1 at the end of the year at 10% is given to you. You are required to answer the following questions. What is the profit before taxes for year number 2, 3 and 4? What is the cash inflow after taxes for year 1, 2 and 3? Cash flow, not profits, cash flow. What is the discounted cash flow after taxes for year number 1, 2, 3? What is the NPV and what is the discounted payback period? Right. Let's try to solve this capital budgeting question. The first and the foremost thing is, this is a replacement decision question. Second thing, this question is to be done by which approach? I have already explained that in case of replacement decision, most of the times we will be applying what? The incremental approach. Why incremental approach, sir? Very clear from one thing. Here, the additional sale units are given, not the total sale or what is the existing sale, then additional sale. No. Additional sale units, additional cost that will be there. Right. So the first and the foremost thing is, this question is to be done by incremental approach. Right. Now, if we try to prepare a timeline of this question, which is going to be very simple, I'll explain you that what is going to be that. Wait, sir. That, okay, I'll prepare the timeline on this side. I'll prepare the timeline here. Now, according to the question, the life of the machine is 5 years. This is 0 period, first period, second period, third period, fourth period, and fifth period. At 0 period, we will have a cash outflow, that is new machinery of 5 lakh rupees. And he says the old machinery can be sold for how much? 10,000 rupees. So we will have a cash inflow of 10,000 rupees. So what will be the net investment, or we call it as incremental cash outflows at 0 period? At the end of the 5th period, this new machinery will have a salvage value of 50,000, sir. Right? And during this period, we will have to find out the CFAT, cash flows after taxes, for all the years. Now, can we prepare just for 1 year, sir? No. Sale units are different. Everything is different. So we will have to prepare a statement of CFAT, and the MCQs are also asking for profit before taxes, cash flows after taxes. So just prepare the statement of CFAT. You will get all the answers, right? Major answers, not all the answers, obviously. So let's try to prepare statement of CFAT. I'll give you the complete solution. Don't worry. Statement of CFAT. See, the purpose of these PVQs is to give you the feel of the paper, right? To give that momentum to you, that how institute has been asking questions and how your mind should work in the paper. That is the main purpose, right? Let's prepare the statement of CFAT for 5 years. Year number 1, year number 2, year number 3. Then we have year number 4 and year number 5. In the statement of CFAT, what is the first thing that we will take? The first thing that we will take is this sales. Sales will be 20,000 multiplied by, right? This multiplied by this, multiplied by this, multiplied by this, multiplied by this. Additional. This is all incremental. We are calculating incremental only, right? So sale multiplied by selling price per unit. So what we will get here is sales. So first thing we'll take here is sales. I'm taking the total value now. Units multiplied by selling price. So for first year, it is going to be 6 lakhs. Second year, it is going to be 7,50,000. Third year, it is going to be 10,50,000. Fourth year, 11,20,000. And fifth year, you have 9,80,000. Now these solutions are not there in the institute suggested answers. Please note that, and you can write down the solutions. I'm giving you the complete solution of the question. Right? Sales. Now, what else? The sales is my cash inflow. Is there any other inflow? Yes, sir. There is a deemed cash inflow. Which one? This one. The savings cost, savings in the cost because of the reduction in the breakages. This is what? A deemed cash inflow. So I will add this. And this is before tax. This is very important. In case of any such savings, you have to see whether it is before tax or after tax. Right? Accordingly, the treatment might change. Fine, sir. Then we have savings in cost. I will add savings. Right? Savings in cost. That is 15,000. 15,000. Then 20,000. 20,000 and 20,000. Right? This is your savings. Sales plus the savings. This is your total inflow. Now there will be a cost also. So minus. First, I will take variable cost. Variable cost per unit is given to you 20, 20, 20, 22, 22 multiplied with the number of units. You will get the total variable cost, right? So I will write the total variable cost. That is 4 lakh, 5 lakh. Then we have 6 lakhs. Then next we have 7 lakh 4,000. And the next we have 6,16,000, right? So this is the variable cost that we have. Now next is the fixed cost is also given, the incremental fixed cost. Yes, sir. We will subtract fixed cost also. Minus fixed cost. Fixed cost of how much? 25,000. Given in the question only, sir. Given in the question only 25,000. Then we have 30,000. Next we have 30,000. Next we have in the fourth year it is 35,000. Fifth year again we have 35,000. Anything else to be taken in the statement of CFAT? Any other expenditure? Yes, sir. Depreciation is to be subtracted. Oh, sir. Depreciation is to be subtracted. That is 90,000. Second year 90,000. Third year 90,000. It is under the straight line method, so it will be 90,000 for all the years, right? So after this, sales minus variable cost minus fixed cost minus depreciation, what will you get? you will get the profits before taxes, right? So from here, what you will get is the profit before taxes, PBT. This PBT will come out to be 1,45,000. I have already done the solution. That's why I'm directly writing the figures. 3,50,000, 3,11,000 and 2,59,000, sir. Right? Yes. Just cross verified once, but otherwise I have done and I have verified the answer. So it's all correct. Right? So PBT is 1,45,000, 3,50,000, 311 and 259. After that, what you will do, sir? We will subtract from here tax. Tax at the rate of 30% is my tax rate which is given in the question. So in the first year it will be 30,000, in the second year it will be 43,500, third year it will be 1,05,000, then it will be 93,300 and last year will be 77,700. So what you will get from here, sir? Profits after taxes, profits after tax, PAT. 70,000 for the first year, then 1,01,500 for the second year, 2,45,000 for the third year, 2,17,700 for fourth year, 1,81,300 for the last year. Right? So we are preparing a simple statement of CFAT, that is cash flows. Now what will you do, sir? Once we have calculated the profit after taxes, we will add back depreciation. We will add back depreciation to find out the cash flows. So I will add 90,000 in each of the years. Right? In each year, I will calculate 90,000, sir. 90,000, 90,000. So what I will get now? The cash flows. Right? Cash flows. How much? 1,60,000, 1,91,500, 3,35,000. Then we have 3,07,700. Then we have 2,71,300. Plus there is one more cash flows in the year number 5. Which one, sir? Can you tell me which one is the cash flow in the year number 5? Yes, sir. This salvage value of 50,000. This will be my cash inflow in the year number 5. So I will add here salvage value. I will add here salvage value here of 50,000 rupees. From here, what I will get is the final CFAT. From here, I will get CFAT. That is, it will be 1,60,000 only here, 1,91,500, 3,35,000, no change here also. Then 3,07,700, no change here also. So it will be 2,71,300 plus 50,000, 3,21,300. This is your final CFAT that you are getting. Clear? Now, can we calculate the present value of CFAT? Let's first see what is the MCQs they are asking. First MCQ they are asking is profit before taxes for year number 2, 3 and 4. Let's see. Profit before taxes means this one. PBT for year number 2, 3 and 4. 1,45,000, 3,50,000 and 3,11,000. Do we have any option with this? 1,45,000, 3,50,000 and 3,11,000. That is option number B. Clear? Next one. Second, what is the cash inflow after taxes for year number 1, 2, 3? That means is asking for CFAT, cash flows after taxes for year number 1, 2, 3. 160, 191, 500, 335. Let's see, is there any option? Option number C. Third option, 160, 191, 500 and 3,35,000. Next, what is the discounted cash inflow after taxes for year number 1, 2, 3? So very simple, sir. What to do? These cash inflows we have calculated, multiplied with the present value factor, you will get the discounted cash flows. Fine, let's do it. So we will multiply it with the present value factors. Now, be careful here. The present value factors are given. For 10% it is given to you. In the question, if the present value factors are given, you have to use exact values. If it is 3 decimal given, you have to use it 3 decimal only. Do not use 2 decimal or 4 decimal. Please be very careful. If it is given 0.909, you have to multiply it with the 0.909. Afterwards, you can do that rounding of thing. 0.909, right? Then 0.826, 0.751, 0.683 and 0.621. So what will be the present value of CF80? What we will get is the present value of CF80. Present value of CF80. What is the value that you will get? 1,60,000 multiplied by 0.909. We will get 1,45,440. Second, we will get 1,58,179. Third, we get is 2,51,585. Fourth, we get is 2,10,159. And the last one, 3,21,300 multiplied by 0.621, that comes to 1,99,527. I have taken rounded off, right? I have taken the rounded off figures. Sir, can we take the rounded off figures in the examination? Absolutely, you can do it. And in that case, you will get the nearby values. Fine. Now they are asking for what? In the MCQ 3, they are asking for the discounted cash flows for year number 1, 2 and 3. What is there for 1, 2 and 3? Discounted cash flows. 1,45,440, 158, 179 and 251, 585. Let's see if we have the values here. Which option, sir? Which option do you think is correct? Obviously, sir, option number D. There is no other option, sir. Option D is the correct one. Right? Now, next is asking for the net present value. What is net present value? It is sum of present value of cash inflows minus sum of present value of cash outflows. What is the sum of present value of cash inflows? Very easy, sir. Take the sum of all this. Simple. Take the sum of all this. This will come to 9,64,890. Somewhere that only you will get. I will cross verify once. 440 plus 158, 179 plus 251, 585 plus 210, 159 plus 199, 527. Yes, sir. 964, 890 exact. So this is your sum of present value of cash inflows, 964, 890. So I'll take here 9,64,890. Now, what is the present value of cash outflows? See here. What are the cash outflows? Sir, this is the net cash outflow at 0 period, 4,90,000. So this is what we will take here. At 0 period, there are no other cash outflows. 4,90,000. So what will be the NPV, sir? NPV will be 4,74,890. Option number C. In the decimals, because I have rounded off, so I'm not getting the decimals, but I got the correct answer, sir. I got the correct answer. Right? This is how the NPV is to be calculated. Next one, what is the discounted payback period of the investment proposal? Now, how will you calculate the discounted payback period? Sir, very simple. We have calculated the present value of the CF80. We will calculate what? We will calculate the cumulative values now. Cumulative values. Right? We will calculate cumulative present value of CF80. That is 1,45,440. Right? Then next cumulative will be 3,03,619. Next will be 5,55,204. That's it. I need this much only. Why? What is the amount that is to be recovered? Amount that is to be recovered is how much? Amount that is to be recovered is 4,90,000. Amount to be recovered is 4,90,000. So it will be somewhere between second year and third year. So what will be the discounted payback period? It will be 2 years plus amount to be recovered is 4,90,000. Till 2 years, how much you have already recovered? That is 3,03,619. So remaining amount is to be recovered from which profits? From this profit we have to recover this amount, that is from 2,51,585. So this will come to 2.74 years. Are we getting somewhere 2.74 years? 2.74, 2.74, 2.74. Yes, sir. Option number A. You can cross verify it with the answers of the ICAI. This is the detailed solution I have given you considering all the parts. This is the detailed solution, sir. Right? ICAI has not provided the detailed solutions. They have just provided option A, B, C, D. That's it. I've given you the whole solution, that this is how the question is to be solved on incremental approach replacement decision question. Easy one, no? It wasn't difficult, sir. It wasn't difficult at all. What say? Or it was difficult? Huh? No, sir. It wasn't difficult at all, sir. It was very easy. So this is how it is to be done. You can note down this solution. Everything we have calculated, NPV, discounted payback period. They can ask for PI also. We can calculate PI if they ask for PI. That is sum of present value of cash inflows divided by sum of present value of cash outflows. The PI we can calculate. Right. So we are done with the case scenario. Good one. What say? Yes, sir. Let's come to the 6th MCQ. The first 5 MCQs were related to the case scenario. The next MCQ is not related to the case scenario, sir. A company has a sales of rupees 6 lakhs, variable cost of 2,40,000, fixed operating cost of 2,70,000. Financial leverage is 2.5. The company wants to double its EBIT. The percentage change in the sales, in the ALES. What is ALES, sir? Institute is doing lot of mistakes now. Change in the sales required in order to double the EBIT. Now that means the first thing that should come to your mind is relationship between sales and EBIT. Which leverage tells us the relationship between the sales and EBIT? Sir, very simple. Operating leverage. So first focus is how to calculate operating leverage. Very simple. Sales are given. Sales of 6 lakh rupees minus variable cost of 2,40,000. So you will get a contribution of 3,60,000. Right? This is your contribution. Minus fixed cost of 2,70,000, fixed operating cost. Right? So you will get here 90,000 of EBIT. 90,000 of EBIT. So what will be your operating leverage? That will be contribution of 3,60,000 divided by EBIT of 90,000. So operating leverage will be 4. Yes. And we have studied that operating leverage is what? Percentage change in EBIT due to percentage change in sales. So operating leverage is 4. What will be the percentage change in EBIT? EBIT they want to double. That means the percentage change will be 100%. So it will be 100% divided by percentage change in sales. So from here we can calculate the percentage change in sales. That will be 25%. Right? That is option number B. Clear on the leverage. So in case of a leverage, in case you get this kind of a question on leverage, first try to understand the relationship, that which leverage tells us which relationship between EBIT or sales, or between EBIT and EPS, or between sales and EPS, that which leverage tells which relationship. This you should know. Clear? Next one, 7th one, sir. Let's come to the 7th one. The capital structure of KPS Limited includes 5 lakh equity shares of rupees 10 each. The market price of the equity share cum dividend, that is including dividend of 75 per share. The company has declared to pay a dividend on the equity share of rupees 6 per share, which will be paid within the next 3 days. So this is what? This is the dividend of the last year that we are going to pay now, right? So this is D0. This is what? This is the D0, current dividend that we are going to pay. The company has a history of the consistent growth in its dividend. It has been predicted that in the next year, the KPS Limited will pay the dividend on the equity shares of 7.59 per share. Now, this is what? This is D1. Fine. The rate of dividend growth will be maintained in the foreseeable future. The cost of equity to be calculated as. Now, which method? First, which method you will apply, sir? We will apply KE is equal to D1 divided by P0 plus growth rate. Firstly, D1 is there, sir. Yes, D1 is given to us, that is 7.59. What will be the price of the share? The price of the share is 75 cum dividend. We always have to take the price X dividend. So the price will be 75 minus the dividend paid is 6. Fine, done. What is the growth rate now? The growth rate is not directly given to you, but what is given? D0 is 6. Then D1 is 7.59. So what is the growth here? We can calculate, sir. How we can calculate growth rate? G 1.59 divided by 6 into 100. Divided by 6 into 100, that is 26.5% plus 0.265. So what will be KE here, sir? 7.59 divided by 69 plus 0.265 into 100, that is 37.5%. This will be your KE. So the important thing is, if the market price is given come dividend, you have to take it excluding dividend. Dividend is paid separately. Second point in this part was the growth rate was not given. The growth rate was to be calculated. So we calculated with the difference of D0 and D1. What is the growth rate? Right. So 37.5%, option number C. Clear? Okay, let's come to the last MCQ, question number 8. ZX Limited has the total assets of 7,20,000 and the shareholders equity is 4,50,000. The net profit margin is 12.5% and the asset turnover ratio is 1.5. Using the DuPont model, the return on equity of the ZX Limited will be calculated as. So DuPont analysis says net profit margin, which is given as 12.5, multiplied by asset turnover given as 1.5, multiplied by what? Multiplied by total assets divided by equity, that is the multiplier, divided by equity of 4,50,000, leverage, basically leverage. So it will be 12.5 multiplied by 1.5 multiplied by divided by 4,50,000, 1.6. So this will come to 30%, sir. Option D. This is DuPont analysis. So as always, I've been saying DuPont analysis, they have not been asking in the main part, but yes, in the MCQ part, they can ask like this, DuPont analysis. Clear? So with this, the MCQs part is done for this. It was easy, isn't it? So small things you have to keep in mind, and very important one thing, if you have noticed that they have been testing on the concepts. So if your concepts are strong, if you are already focusing on the small points in the class, then you cannot miss out even on a single thing. You will be able to solve all the MCQs. Yes, fine. Now let's continue to the descriptive part, sir. The descriptive part, question number 1, A part. Financial information for the year 2023-24 of the two companies N Limited and C Limited are as under. Okay, equity share capital of rupees 100 each, 10 lakh and 8 lakh. Debt is given 5 lakh at 10% and 7 lakh at 8%. Fixed cost is given 3 lakh and 3 lakh 36,000. Combined leverage of 8 and 4.5 and financial leverage of 2 and 1.5. You are required to calculate the contribution for N Limited and C Limited, margin of safety in percentage for N Limited and C Limited, and the sales of C Limited. First of all, how can you calculate contribution? Sir, any way in which we are able to find out the contribution, sir? How we can find out, sir? Just think about it. From equity share capital? No, sir. From debt? No, sir. From fixed cost? No, sir. Any other way? Yes, sir. Now, just try to understand. We have combined leverage and financial leverage. From here, can we find out operating leverage? Operating leverage will be combined leverage divided by financial leverage. Combined leverage is how much? 8 divided by 2. So operating leverage will be 4. Another thing that we have, financial leverage is given. Can we write financial leverage as EBIT divided by EBIT minus interest? Yes, sir. EBIT divided by EBT. EBT I can write it as EBIT minus interest. So if I talk about N Limited, I'm talking about one company, the other company you will be able to find out, sir. Okay. So what is financial leverage? Financial leverage is given as 2. EBIT we need to calculate, sir, divided by EBIT minus interest. Interest is there, 10% on 5 lakh rupees. 50,000 is your interest. From here, we can calculate this EBIT, that is 2 EBIT minus 1 lakh rupees is equal to EBIT right? Take the EBIT here, 2 EBIT minus EBIT will be how much? 1 lakh. Now can you calculate contribution? Yes sir. Operating leverage is there 4, EBIT is there 1 lakh. So operating leverage is equal to contribution divided by EBIT, right? What is there sir? Operating leverage is equal to contribution divided by EBIT. Right, so 4 is equal to contribution divided by EBIT of 1 lakh rupees. So what will be the contribution? Contribution will be 4 lakh rupees. This is, I have calculated for N limited. Now you can calculate for C limited on the same lines. Absolutely same way you can calculate for C limited. Fine. The next part is margin of safety in percentage. Very easy sir. 1 divided by operating leverage, 1 divided by 4, right? That is 25% for N limited. Similarly you can calculate for C limited. Any doubts in this thing? No sir, right? Now sales of C limited. How, from the given information, how can you find out the sales? Just think about it. Sir, this is a problem in the question now. Because some information is missing in the question itself. We can't find out the sales from whatever the information we have done or whatever the information we have calculated. We will not be able to calculate the sales from there. Right, so what they have done is they have assumed PV ratio to be something, right? So here assumption is to be made. Here you have to make an assumption with regard to PV ratio, right? Let's say the PV ratio is, they have assumed it to be 40%. You can assume it to be 30%, 20%, or anything you can assume it to be, right? Now contribution you have already calculated in the first part. So sales you can calculate. Sales is equal to contribution divided by PV ratio. Right, contribution you have already calculated in the first part. So this was a technical problem, missing information in the question, right? So any assumption is valid. They have assumed it 40%. You can assume it anything, 30%, 35%, 40%, approximate PV ratio. Fine, clear? So this is question number 1A part. Now coming to the B part of the question. The following information is available for SK Limited for the year ended 31st of March 2024. Cost of production is given 15,48,000. Cost of goods sold is given 14,61,000. Average stock of WIP is 94,600. Average stock of finished goods is given. Administration and selling expenses are given. Then receivables collection period, that is R, is given to you. Raw material storage, receivables collection period is R plus W plus F plus D. Debtors collection period, it is D that is given to you. This is R that is given. This is C that is given to you. Calculate the working capital requirement by operating cycle method. So first you will have to calculate what? First you will have to calculate operating cycle. Now what is operating cycle? Operating cycle is R plus W plus F plus D minus C. That is raw material plus WIP plus finished goods holding period plus debtors collection period minus C. In this R you are having 65 plus W we need to calculate plus F also we need to calculate plus D is there 36 minus 63. Now how can you calculate W? That is WIP holding period. That will be average stock of WIP 94,600 divided by what? Divided by the cost of production per day. Cost of production per day, that is 15,48,000 divided by 360, right? So that will give you the value of W, that is 22 days, right? So here W will be 22. Now F, how do we calculate F? F will be the average stock of finished goods divided by cost of goods sold per day. That is 2,43,500 divided by 14,61,000 per day. So divided by 360. That comes to 60 days. Right? 60 days. So what will be your operating cycle here, sir? Operating cycle here will be 120 days. Just check it once, right? Operating cycle here will be 120 days. Now, next we will calculate number of operating cycles. Number of operating cycles, sir, that will be 360 divided by 120. That is 3 cycles, 3 times. What is the requirement of the question? The requirement is to calculate the working capital requirement. So working capital will be, working capital is for the amount that is invested. Amount will take as cost of goods sold, right, sir, after the adjustment of opening and closing, because opening we have taken it in the last period, sir, right? So after the adjustment of opening and closing WIP, cost of goods sold 14,61,000, cost for which the working capital is required, plus selling and distribution expenses, that is 4,14,000 divided by number of cycles 3. So for every cycle, the amount of working capital that will be required is 6,25,000. This is the total cost incurred during the year divided by number of operating cycles in a year. You will get that in one operating cycle, what will be the amount of working capital that will be required. Clear? So this was question number 1B part. Let's come to C part, ratio analysis. The following information relates to MNP Limited for the year ended 31st of March 2024. Inventory turnover ratio based on cost of goods sold is given 7.5 times. Total asset turnover ratio is 2.5 times. Long-term debt to shareholders funds is given 0.6:1. Debtors collection period is given as 30 days. Then gross profit ratio is given as 25% on the sales, and current ratio is given 2.9:1. Fine, sir. You have to complete this balance sheet. You are required to complete the balance sheet of MNP Limited. Assume 360 days in a year and all sales are on credit sales. So how can you start? Equity share capital is given, reserves and surplus are given, then long-term debt is not given, creditors are given. What will be your first step? Sir, long-term debt to shareholders funds is given 0.6:1. What is given? Long-term debt to shareholders funds, that is 0.6:1. Sir, can we find out the value of long-term debt from here? Yes, sir, because the shareholders funds are given as 9 lakh. So long-term debt will be how much? 0.6 into 9 lakh. 5,40,000 will be my long-term debt. So I will write here 5,40,000. So what will be the total of the liabilities sides? That is 17,40,000 will be the total of liability side. Now total liabilities is equal to total assets. 17,40,000 will be my total assets. Next, total assets turnover ratio is given, then gross profit is given, current ratio is given, sir. Current ratio is current assets divided by current liabilities, 2.9:1, right? So he says current assets, that is divided by current liabilities, is equal to 2.9:1. So can I say current asset is equal to 2.9 multiplied by, what is the current liabilities here? Current liability is only this creditors of 3 lakh rupees. Of 3 lakh rupees. So it will be 3 lakh multiplied by 2.9, that is 8,70,000 of the total current assets, right? This total of current asset is 8,70,000. Now from the total asset, if I subtract my current assets, I will get the value of fixed asset from 17,40,000 minus 8,70,000. Wait. 17,40,000 minus 8,70,000. So my fixed asset here is 8,70,000. Now what is left? I need to find out these values: inventory, debtors and cash. How can I find out? Now total assets turnover ratio is 2.5 times. That is total sales divided by total assets. Total asset turnover ratio is what? It is your sales divided by total assets is equal to 0.25. No, sorry, 2.5. Yes, sir, 2.5. It is 2.5. Now total assets you have. Yes, sir. Sales is what? Sales is 2.5 into total assets. That is 17,40,000. Right? So sales will be 43,50,000. Sales will be 43,50,000. Now, can you tell me the COGS? Yes, sir. The gross profit rate is given 25%. So COGS will be 43,50,000 minus 25% on that. My COGS will be 32,62,500. Clear? This will be your COGS. Absolutely correct, sir. Now the inventory turnover ratio is given, that is 7.5 times. Right? So what is ITR? Inventory turnover ratio is equal to COGS divided by either the average inventory or the closing inventory. Here opening inventory we do not have, so we will take here what? The closing inventory. Please remember here, either we can take average inventory if we have opening and closing both the balances, or we can take only closing balances. So COGS is given 32,62,500 divided by closing inventory is equal to 7.5. Yes. So what will be the value of closing inventory from here? That will be 4,35,000. 4,35,000. Okay, sir. Inventory is how much? 4,35,000. Now what is left? Debtors. What is given regarding the debtors, sir? What is given regarding the debtors? Debtors collection period is given. Now for debtors, what we are going to use is the debtors collection period, that is given as 30 days. Now what is debtors collection period? What is debtors collection period? Debtors collection period is given as, how we write it? Average debtors or closing debtors, average or closing debtors divided by credit sales per day. Credit sales per day. So this is given as 30. Debtors we need to calculate, sir. Closing debtors we will calculate, divided by sales is given, sales we have calculated as 43,50,000 divided by 360. So if you solve this, you will get the value of debtors from here. The debtors value will be 3,62,500. Yes, 3,62,500. 3,62,500. Now what is left is cash. So 8,70,000 total current asset minus 4,35,000 of inventory minus 3,62,500 of debtors. 72,500 is your cash. That is your balancing figure. Complete, sir. Balance sheet complete. 5 marks question. A good question, sir. Very good question. Ratio analysis. Normally we get these kind of questions where they ask you to complete the balance sheet, right? So it has some relevance. Important, sir. So we are done with question number 1. Let's move on to question number 2. Fine. Let's move on to question number 2. Capital structure of T Limited as on 1st of April 2024 is as under. Equity share capital is given, 10% debentures are given, and 12% preference shares are given to you. The risk-free rate of return is 10%. The beta of the company is 1.75 and the return on the market portfolio is 12%. The equity shares have the current market price of rupees 70 per share. So one thing is very clear from the given information, that you have to apply which model? You have to apply capital asset pricing model for the calculation of KE, right? So KE will be how much? Risk-free rate of interest plus beta factor into market return 12 minus 10. So this is how the KE will be calculated, sir. Isn't it? This is how the KE will be calculated. It will come to 13.5%. The debentures are trading at a market price of 80 per debenture. Fine, sir. The debentures are to be redeemed after 5 years at par. So redemption value is 100. These are redeemable debentures. Fine. preference shares are redeemable after 5 years at a premium of 5%. So redemption value will be 105. Presently selling at 104. Net proceeds will be 104. Right? Time period is 5 years. The company pays the tax rate of 30%. The cost of debenture is to be calculated on the yield to maturity approach. This is what the IRR approach is, sir. Further, the present value factors are given 10% and 14%. You are required to calculate the weighted average cost of capital after tax of T Limited using the market value weights. Sir, very easy. KE you have calculated. KP you can calculate, sir. It is a redeemable one. Right, so for KP, what will be the formula? That is D plus redemption value minus net proceeds divided by N whole divided by redemption value plus net proceeds divided by 2. What will be the dividend here, sir? Dividend will be 12% on 100 rupees. That is 12 plus what is the redemption value here? Redemption value is 105 minus the net proceeds is the market price, current market price 104. Divided by N is how much? N is 5 years. Okay, divided by 105 plus 104 divided by 2. So solve this. What you will get, sir? 12 plus 0.2 divided by 104.5. Right, so it will be 12.2 divided by 104.5 into 100. 11.67% according to me. Yes, sir. 11.67%. This will be your KP. Now, what will be your KD, sir? What will be your KD? And the KD is to be calculated using the yield to maturity. That is, you have to calculate IRR using 10% and 14%. Now the rates are specified in the question. You have to calculate using 10% and 14%. Now what will be there in case of the debt? Just try to understand the timeline here now, sir. Just try to understand the timeline. It is 5 years. Yes, sir. It is 5 years. Okay. So I'll take 5 years timeline here. 0 period, first period, second period, third period, fourth period and fifth period. Right? At 0 period you will have what? When you will issue the debenture, you will have a cash inflow. How much will be your cash inflow? The debenture is currently being traded at 80 rupees. So this will be the net proceeds. Fine, sir. 80 rupees. So cash inflow of 80 rupees, sir. Right? Here you will have a cash outflow, that is the redemption value of 100 rupees. Yes, sir. Now every year you will pay what? There will be a cash outflow every year. What will be that? Interest amount. What will be the interest amount? Interest amount will be 10% on this 100 rupees minus the tax of 30%. Right? So this interest amount will be 10% on 100 rupees into 1 minus 0.30. It will be 7 rupees every year. Interest 7 rupees every year. Interest 7 rupees. Interest 7 rupees. Here also interest 7 rupees. So you can calculate now the NPV. Here the NPV calculation will be done. You will calculate the NPV at 10%. Right? That will be how much, sir? That you will take sum of present value of cash outflows minus sum of present value of cash inflows. This is how you will take, because here we are talking about the cost. For cost we need the outflows more than the inflows. So we will take sum of present value of cash outflows minus the sum of present value of cash inflows. Clear? So cash outflows is what? The sum of present value of cash outflows 7 into present value factor, annuity factor of 10%. That is this total, sir. Total of this, sir. Total of this, that is 0.909, 0.826 plus 0.751. Oh, wait. 0.909 plus 0.826 plus 0.751 plus 0.683 plus 0.621, 3.79. Right, so it will be 7 into 3.79 plus redemption value of 100 into 0.621 minus 80. Right, so this will come to how much? This will come to, sir, 26.53 plus 62.1 minus 80. Right, so 26.53 plus 62.1 minus 80, that will be, wait, sir, wait. Yes, that will be 8.63. Now it is a positive NPV. What we need for IRR, we need NPV is equal to 0. Right, that will be your KD. But so that means we need a higher rate. Higher rate at what percentage? 14%. That is a direct hint given in the question itself. So you will calculate NPV at 14%. Right, so that will come out to minus 4.076. Now you can do what? Now you can go for interpolation. How the interpolation will be done? I will tell you the interpolation also. 10%, 14%. At 10%, your NPV is 8.63. At 14%, it is minus 4.076. We need IRR somewhere between this, where the NPV will be 0. For a change of 4%, what is the change here? 8.63 plus 4.076, that is 12.706. Right, so what we say now? Now if we change the NPV by 12.706, the change in percentage is 4%. Now if we change the NPV by this, because we need the NPV 0, so if we change the NPV by this, 4 divided by 12.706 multiplied by 8.63. 4 divided by 12.706 multiplied by 8.63. That comes to 2.72. Right. So the IRR or KD will be 10% plus 2.72%. That comes to 12.72%. This is how you have to approach the yield to maturity method. That is IRR, interpolation. Clear, sir? Any doubts in this thing? It should be absolutely clear. Very important. This yield to maturity method, they have been constantly asking now. Now the market values are given to you. Right? Number of shares. Take the number of shares here. It will be 5 lakh shares multiplied by the market value of 70. Then you have debentures. How many debentures are there? 40,000 debentures are there. And similarly, 10,000 preference shares are there. So multiplied with 70, multiply the debt with 80, and this multiplied with 104. You will get the market values. Now you can solve. Now you can calculate the WACC using the market value, sir. Isn't it? Okay, equity share capital 70 into 5 lakh, 80 into 40,000 and 104 into 10,000. Market values you will get. Calculate the weights. KD, KP, KE you have calculated. Calculate the WACC. That comes to 13.39%. Right? So important point is the calculation of KD, KP and KE. It wasn't a difficult question. The only thing is you should know how to apply the yield to maturity method. That's it. Right? Okay, next question. Question number 3. Come to question number 3. AB Enterprises deals in the hardware material having the current turnover of rupees 30 lakhs per annum. All sales are on credit and the average collection period is 30 days with the 0 bad debts. Cool. The customers are requesting to increase the credit period. As a result of increase in credit period, the sales will also increase. So information is given. Credit policy A and B. Increase in collection period is 15 days and 35 days. Current period is 30 days. Increase in 15 days, that means 45 days here and total of 60 days here. Increase in sales 3 lakh and 5 lakh. Current sales is 30 lakhs. So here the sales will be 33 lakhs and 35 lakhs. Okay, the bad debts, current bad debt is 0%, then the bad debts will be 1% and 3.5%. The selling price is rupees 100 per unit, variable cost per unit is rupees 50 and the fixed cost is rupees 5 lakh. Required rate of return on the additional investment is 20%. This is the rate of return for opportunity cost. The creditors for variable cost are ready to give 15 days extra credit for additional cost incurred. Assume 360 days year. Sir, what is this? Variable cost creditors, they are ready to give 15 days extra credit. Extra credit. Cool, sir. That is very good. Rest, the question is simple. Sales you will calculate, credit sales you will calculate, total cost other than bad debts, that is variable cost and fixed cost. Then bad debts you will calculate, expected profit you will calculate. No issues. The issue will be in the opportunity cost only. The first part is simple. Credit days are given, units sold you can calculate. Then credit sale, variable cost, fixed cost, bad debts and expected profit. When you will calculate opportunity cost, no. Opportunity cost, cost of sales. Firstly, the bad debts are not to be considered. Only this part is to be considered. Please be very careful. For opportunity cost, the bad debts are not to be considered. For opportunity cost, this cash discount is also not to be considered. It will impact your profits, but there is no extra cost that is being incurred. So we will not take it in the opportunity cost. So first we will take 20 lakhs, 21 lakh 50,000 and 22 lakh 50,000. What is average debtors? Average debtors means the cost of sales. Average debtors or investment in debtors. Average debtors is cost of sales. Cost of sales into average collection period divided by 360. So that is what is done here. Cost of sales into credit period. Credit period we have 30, 45 and 60 divided by 360. Now, what next, sir? Creditors for extra variable cost. Variable cost into 15 by 360. Now, what will happen here? When you will get extra time period for the variable cost, it will reduce your investment in the debtors. You are giving extra period, sir. You are getting extra period from the creditors, not debtors. From the creditors, you are getting extra period. So your opportunity cost will come down. Yes, your opportunity cost will come down. So here, whatever is the average investment in the creditors, 6250 and 10417, you will subtract minus this is equal to this value. Your debtors in average debtors will reduce. Your investment in the debtors will reduce because you are getting extra credit period from there. You don't have to make payment. You have not made payment yet. So it will reduce your investment. Investment is what? Investment is when you have made the payment. But here you are getting 15 days extra. So for 15 days you have not made that investment. That will reduce your investment here. Right? So average investment. Now you can calculate opportunity cost at 20%. This is the important point of this question, sir. Right? That when you are getting extra time period from the creditors, you are making the payment late to the creditors, your investment will be late by 15 days. So reduce the investment by those 15 days creditors. Reduce, minus, not add. Clear? So this is the important point of this question. Rest of the question was easy. Rest of the question was not difficult. Simple question on debtors. Let's come to the B part. Let's come to the B part, sir. ER Private Limited has a paid up capital of rupees 2,50,000 consisting of 25,000 equity shares of rupees 10 each. The market price per share is rupees 24 with a PE ratio of 8 rupees. The company is planning to purchase a plant which will cost rupees 5 lakh. The plant is expected to yield the earnings before interest and taxes of 2 lakhs per month. That is, from this plant we are expecting this much EBIT. It has two alternatives to finance the plant. Alternative 1, 100% A alternative 100% equity, B alternative 50% equity, 50% debt. The other information is as under. The cost of debt is 12%. The equity shares of the face value of rupees 10 each will be issued at a premium of rupees 10. Right? So issue price will be how much? Issue price will be 10 plus 10, 20 rupees. The PE ratio of the leveraged company will be 7. The tax rate is given as 40%. Advise which alternative is most suitable to raise the funds for the additional capital, keeping in mind to maximize the benefits to the shareholders, that is maximization of EPS and MPS. Right, maximization of EPS and the MPS, that is the benefits to the shareholders. So you have to evaluate, sir. Existing number of shares are also there, so there are two options. Basically there are two options. You want to raise how much? You want to raise how much, sir? Okay, 5 lakh rupees you want to raise. 5 lakh rupees you want to raise. Now for this 5 lakh rupees you have two options. One is all your equity option. Second is equity plus debt option. Right? So in the equity option, what is the existing number of shares? Existing shares is 25,000 shares, and under the equity plus debt 25,000 shares. Right? What will be the new number of shares? New shares you will issue. New shares you will issue for 5 lakh rupees. At what price? At 20 rupees per share given in the question, sir. 25,000 more shares you will issue. Right? In the equity plus debt option, what will be the new shares that you will issue? That is, you will issue it for 2,50,000 divided by 20. 2,50,000 divided by 20, that is 12,500 shares new you will issue. So total shares will be how much? Here 50,000 shares and here 37,500 new total shares will be there. Right? Now, you know what is the problem in this question? There is just one missing link in this question, sir. Number of shares you have calculated, everything we will be able to calculate, sir. The only thing is, sir, when you will prepare the statement, you have some existing data also. Existing shares are there and everything is there. You don't have the existing EBIT. Sir, why do we need existing EBIT, sir? You need it, sir. Why not? If you are going to take the new existing shares, you will need the existing EBIT. Sir, EBIT we have not 2 lakh rupees. This is from the new plant only, sir. The existing EBIT we are not having. Sir, how we can calculate the existing EBIT, sir? We can calculate. How? Existing EBIT. How we can calculate existing EBIT? Sir, what is the market price existing that is given to you? 24, sir. What is the PE ratio that is given to you? 8, sir. What you can calculate using this? What is PE ratio? PE ratio is MPS divided by EPS. Now PE ratio you had, MPS you have 24 divided by EPS. So can you calculate EPS from here? Yes, sir. EPS will be 3. This is earnings per share. Can you calculate the total earnings, or we can say earnings after tax? This EPS is paid out of what? Earnings after tax, because there is no preference share capital. So this is your residual earnings. So earnings after tax is how much? 3 multiplied by 25,000 shares. 75,000. 75,000 rupees. This is after tax. Add tax to it. You will get EBT. That will be 1,25,000. Add the tax value to this 75,000, you will get the EBT. This is your EBIT, because in the existing capital structure there is no interest. If there is no interest, that means your EBT and EBIT will be same. So this will be your existing EBIT, new EBIT you have. Now you can do the evaluation, sir. Right? Now you can do the evaluation. This part was important. 1,25,000. See here. Evaluation. Existing, alternative A, alternative B. Existing EBIT calculated, sir. From the new project, 2 lakh given, sir. Total EBIT less interest at 12%. Only in alternative B. Existing we do not have debt. In alternative A also we are going for 100% equity only, no debt. Right? So you will get EBT less tax. You will get EAT. Then divided by number of equity shares. Number of equity shares we have already calculated, sir. Right? Number of equity shares we have calculated. 25,000 existing, 50,000 under the A plan, 37,500 under the new plan. I have given you this. Where it is? Oh, sir, where it is gone, sir? I have already given you the calculation of this. Okay, this part. See here. Total number of shares 50,000 and 37,500. Clear? Now, after that, so EPS you will get EPS multiplied with the PE ratio. Now, PE ratio of the levered company. Levered company is the which one? Levered company is the one having debt in the capital structure. So in alternative B, the PE ratio will be 7. Otherwise, the PE ratio will be 8. Right? So multiply market price per share will be EPS into PE ratio 24, 31 and 33. So we can say that on the basis of EPS, option B is good, and otherwise also option B is good, sir. On the basis of MPS also option B is good, having the maximizing the wealth of shareholders. Alternative B, that is issue of 12%. Debenture is most suitable to maximize the market price per share. Right? So this is how we can do, sir. A good question on capital structure. This question is on capital structure. So we are done with this September 2024 paper. Next we'll take up is January 2025. Right? So see you guys in the next video. Till then, stay safe, stay healthy, keep studying, keep sharing. Thank you so much. Right? You can just go through with the theory part once. The features of crowdfunding, it is from second period. Discuss the relevance of payback, reciprocal and capital budgeting decisions, ABC approach and all those things. You can just go through with once. Some of the forms of bank credit, some forms you need to write down only a few forms, sir. Right? So reciprocal of payback will be the close approximation of the IRR. If the life of the project is at least the twice of payback period, just go through it once. Just read it once. Right? Rest everything we have covered. The practical part we have all covered. Right? Let's now discuss January 2025 PVQ. Financial management PVQ of January 2025. If you talk about the level of the paper, it was very easy, sir. It was easy. Not even I would say easy to average. I will say it's easy. Comparatively very easy paper. No as such fancy adjustments or difficult points. Nothing, sir. Straightforward questions. Let's start with the case scenario. Coral Limited is an agri-business company that operates in two segments, animal feed and the crop protection. The company's research and development department has been instrumental in the growth and success. The existing capital structure of Coral Limited is as follows. Equity share capital 10 lakh shares of 10 each, 1 crore rupees. 15% debentures, 30,000 debentures of 10 each, 30 lakh rupees. The Coral Limited desires to expand the horizon in the breeding, high yielding and disease resistant seeds for increasing the agriculture productivity. The company requires the additional funds amounting to rupees 100 lakhs, that is 1 crore rupees, to finance the existing expansion plan. The expected earnings before interest and taxes, that is EBIT, after the additional investment will be 76 lakhs. The applicable income tax rate is 30%. The company has two alternatives for raising the additional funds. Plan A, Plan B, Plan 1, Plan 2. In Plan 1, 30% will be raised through equity share capital and 70% will be raised through debt. In the Plan 2, 10% through equity share capital, 50% through debt and 40% through preference share capital. Equity share capital of rupees 10 each will be issued at a premium of rupees 25. That will be 25 rupees. 13% debentures and 7.15 preference shares. You are required to answer what would be the earnings per share of the company, Plan 1, Plan 2. Now, if you want to calculate EPS, what is the best way, sir? Prepare the income statement. That's it. EBIT is there. Interest on debt is there. Interest on debt. Now, please be very careful. You have to take the interest on existing debt as well as the interest on the new debt. Right? So I have prepared a bit of a solution here. I will show you. See, first I'll give you the summary. Plan 1. Plan 1 is what, sir? Plan 1 is equity and debt. The total amount to be raised is 1 crore rupees, 100 lakhs. Right? In the Plan 1, 30% is equity and 70% is debt. That is 30 lakhs of equity and 70 lakhs of debt. Now, for debt, 13% is the rate of interest. So, interest will be 9,10,000. This will be interest. For equity, I will need the number of shares. number of shares will be 30 lakhs divided by what? Divided by 25 rupees. This will give me what? 1,20,000 shares. New shares will be issued. Existing shares we are having 10 lakh of existing shares we are having. 1,20,000 new shares will be issued. Fine, sir. Under plan number 2, equity, debt and preference share capital, 10 lakh of equity divided by 25, 40,000 shares will be there. 50%, 10% is equity, 50% is debt, and 40% is preference share capital. So debt is 50 lakhs at 13% rate of interest. So interest will be 6,50,000. Preference dividend 40 lakh at 7.15% dividend. So dividend amount will be 2,86,000. Right? This is plan 1 and plan 2 summary that I have created. Now I can prepare the income statement. Plan 1, EBIT is given 76 lakh minus interest. Interest, please be very careful. Do not forget about the existing interest. Existing interest is how much? 15% on this 30 lakh rupees. Right, 4,50,000 is the existing interest which will be there under both the plans, plan 1, plan 2. It will be there under both the plans, sir. Plan 1, plan 2. Now new interest I have calculated here 9,10,000 and 6,50,000. So I will get EBT. On that I will pay a tax of 30% as given in the question. So you will get EAT. After EAT, first you will pay preference dividend. Preference dividend is only in plan 2. The dividend is 2,86,000. So you will get the residual earnings. Residual earnings divided by number of shares. Number of shares means what? Existing plus new. Existing shares is 10 lakh shares. Right? Existing share is given in the question that it is 10 lakh shares. Plus what is the number of new shares being issued? Here we have seen new shares is 1,20,000 and 40,000. So in the first plan it will be 11,20,000. In the second plan it will be 10,40,000 total shares. That is what we have taken here. Right? Number of shares, EPS you will get 3.9 and 4.1. This is what is the requirement of part A, 3.9 and 4.1, that is option C. Then he says what would be the market price per share of the company if the price earnings ratio, that is PE ratio of plan 1 is 12 times and plan 2 is 15 times. So what is MPS? MPS is EPS into PE ratio. EPS into PE ratio. PE ratio is given. EPS we have calculated. Multiplied by PE ratio, you will get the MPS, that is 46.8 and 61.5. Option A. Right. Third part, what would be the financial break-even point in plan A and plan 1 and plan 2? So in plan 1, when there is no preference dividend, what will be the financial break-even point? Whatever will be the interest, this total interest value, that is 13,60,000. Financial break-even point is what? That the earnings are just sufficient to pay my financial fixed cost, that is the interest on debt and preference dividend. So for plan A, the financial break-even point will be 13,60,000. Now 13,60,000 is only one option, option D. But in case you have two options, how will you calculate the financial break-even point for plan 2? That is going to be interesting, sir. Financial break-even point, if you talk about plan 2, sir, financial break-even point, wait, financial break-even point for plan 2. For plan 2, it will be what? Two components. One will be interest. Second component will be what? Second component will be preference dividend divided by 1 minus tax. So interest here is 11 lakh rupees plus preference dividend of 2,86,000 divided by 1 minus 0.30. So this we will have to see. That comes to 11 lakh plus 4,08,571. That is 15,08,571. This is how the financial break-even point of plan 2 will be calculated. when you have both interest as well as preference dividend. In case of preference dividend, because it is being paid after tax, you need to find out the earnings before tax, so that after the payment of tax you are left with the amount of preference dividend. Clear? This is a very important point, sir. So 15,08,571, this is what we are getting. Yes sir, 15,08,571. Correct, option D. What would be the indifference point between plan 1 and 2? What is indifference point? Sir, that level of EBIT where the EPS of plan 1 will be equal to EPS of plan number 2. Right? EPS of plan number 1 will be equal to the EPS of plan number 2. So I have done some working on this. Where is the working, sir? Indifference point where EBIT minus interest into 1 minus tax divided by number of shares. This is for plan 1. This will give you the EPS for plan 1. Here EBIT minus 11 lakh into 1 minus 3 minus preference dividend divided by number of shares. So if you solve this, you will get the EBIT. You will get the EBIT of 34 lakh 40,000. So we have the option number B, 34 lakh 40,000. Right? Now the last part is asking what will be the EPS in plan 1 and plan 2 at the indifference point calculated above. How will you do that, sir? Very simple. Now EBIT you have calculated 34 lakh 40,000. For this part 34 lakh 40,000. Right? Now one thing is clear. One thing is very clear. What, sir? At indifference point EPS will be same. So calculate under just one plan. Calculate under plan 1. Just put in the value of EBIT here, 34 lakh 40,000 minus 13 lakh 60,000 minus 13 lakh 60,000 into 1 minus tax divided by number of shares 11 lakh 20,000. So calculate this. How much? 34 lakh 40,000 minus 13 lakh 60,000 minus 30% divided by 11 lakh 20,000. 1.3. So under both the options it is going to be 1.3 only, sir, because at indifference point it will be same, 1.3 and 1.3. Clear? So this is case study, very easy case study, isn't it? You just have to prepare what? The income statement. Everything you will get from there. Very basic capital structure. This case study is on which chapter, sir? This case study is on your capital structure. But isn't it too easy, sir? Yes, sir. Isn't this too easy? Okay, let's come to the next one. Case scenario 2. VP Limited provide the following information. Okay, what is the following information which is given, sir? Current ratio is given 1.5:1. The sales 80% on credit. That means out of this 80% is your credit sales, 120 lakhs. Inventory turnover ratio 6 times. Average collection period 2 months. Gross profit ratio 20% and quick ratio 1:1. Calculate the value of inventory and receivables. How will you calculate inventory? Inventory will be calculated using inventory turnover ratio. How so ITR will be what? The ITR here will be COGS divided by inventory. What will be COGS, sir? COGS will be sales minus GP, that is 150 minus 20% divided by inventory, that will be equal to 6 times. Right? So 120 divided by inventory will be equal to 6 times. From here inventory will be 20 lakhs. We are calculating in lakhs. So that means either it is option A or option D. Option B and C eliminated. Now comes the second part, that is receivables. What is given? Average collection period is given to you. What is average collection period? That is debtors divided by credit sales divided by credit sales per day, credit sales per month. Here it is given in the month, so we will take it in the month. Average collection period is given as 2. 2 is equal to debtors divided by credit sales is 120 and not 150. Please be very careful. Divided by 12 months. So it will be 10. 2 multiplied by 10 is equal to debtors. So debtors will be 20 lakhs. So the option will be option number A. 20 lakhs of inventory and 20 lakhs of debtors. Inventory calculating using the COGS by inventory and the debtors calculating using the average collection period. Please be very careful with the small calculations, that here you have to take the credit sales and not the total sales. If you take 150, wrong. Right? If you are going to take 150, it will be absolutely wrong, sir. Clear? Okay, now let's come to the next one. He says, what will be the value of current assets and current liabilities? How can you calculate, sir? Current ratio is given 1.5:1. Yes, sir. So current assets, can I write it like this? Can I write it like this, that current assets is equal to 1.5 current liabilities? Yes, sir. Then the quick ratio is given 1:1. What is quick ratio? Current assets minus inventory divided by current liabilities is equal to 1/1. From here, can I say current asset, I will replace it with this 1.5 current liabilities minus inventory we have calculated is equal to current liabilities. So it will be 0.5 current liabilities is equal to 20, current liabilities is equal to 40. Right? So current liabilities are 40. What will be the current assets? Current assets will be 60. That is 1.5 CL. So for current asset is 60 and current liability is this, option number C. Extremely easy. The one thing is, the problem can be there with the easy paper also. The problem is if you do not work out on the concepts. What some people focus on is doing difficult questions, or do the difficult to difficult questions. And if the paper is easy, you have not worked on the concepts, then you are going to suffer. So first and the foremost thing is understanding the concepts, understanding the logics. Coming to the next one. JKL Limited has the current assets of, current assets of 1 crore and the current liabilities of 50 lakhs. The financial manager of the company desires to make a provision for the contingencies at 20% of the working capital. Accordingly, what would be the amount of working capital required for the company? Sir, what, sir? Current assets 1 crore minus current liabilities of 50 lakhs plus 20%. Simple, sir. 50 lakh plus 20%, that will be 60 lakh rupees. 60 lakhs will be option B. That's it. 60 lakhs working capital required. The end. Finish. Right. So the MCQ part is done, sir. Wasn't it easy? The next one is strategic management. I'm taking only the financial management part. Come to question number 1, descriptive questions. Cash budget. The KP Limited has provided the following information. Estimated monthly sales are from April to September. The sales are given in lakhs. The gross profit is 20% and the cost of goods sold is paid in the next month. Can you tell me what will be the COGS here? What will be the COGS here? That is 10 minus 20%. That will be 8. Right? 12 minus 20%. That will be 9.6. 15 minus 20%. That will be 12. Right, so 10 minus 20% will be 8. 13 minus 20% will be 10.4 and 14 minus 20% will be 11.2. This is the cost of the goods sold. Now he says it will be paid in the next month. That means the cost of the April will be paid in May. For May it will be June. For June will be paid in July. Here. Right, so I'll take the payment here. Okay, I'll write like this. Wait. Okay, so I will write here the payment. Right, this 8 will be paid here, 9.6 will be paid here, 12 will be paid here, 8 will be paid here, and 10.4 will be paid here. Fine. The sales are in the credit and the credit period allowed is 2 months. That means this 10 will be paid here. 10 will be paid here, 12 will be paid here, then 15 will be paid here, and 10 will be paid here. Clear? Okay, the indirect expenses are paid in the same month and the monthly indirect expenses are given to you from June, July, August and September. Fine. The dividend amounting to September, 3 lakh will be paid in the month of September. Okay, the cash balance on 1st of July is given as 1.5 lakhs. The company has to maintain a minimum cash balance of 1 lakh rupees. If there is any cash balance deficit in any month, the company would take a temporary short-term loan, and if the cash balance exceeds 2 lakh rupees, if you are having excess cash of more than 2 lakh rupees, then the company would invest for short term excess amount of 2 lakhs. If it is a shortage, then company will take in such a way, loan in such a way that the balance is 1 lakh rupees. But if the amount is in excess of 2 lakh rupees, then the company, what company will do? Company will keep 2 lakh rupees and the excess amount they will invest. This is little bit of a twist in this particular line. Ignore the interest on short-term loans and short-term investment. Prepare a cash budget for 3 months starting from July. That is July, August and September. You have to prepare a cash budget. So if you talk about receipts, receipts will be from sales 12, 15 and 10. Right? Then what else will be the receipts, sir? Any other receipts will be there? This is your opening cash balance. Right? I don't think so there are any other receipts. Receipts are from sales only. Then payment will be one COGS payment of this, then indirect expenses payment of this, then in September you will pay dividend, right? That's it. So if you see the yes, opening balance of 1.5, in the receipts, collection from debtors 12, 15 and 10, payment of COGS, indirect expenses and payment of dividend, total payment, closing balance before adjustment. Now in the first year, see, in the month of July, you have a balance of only 0.3. What is the balance that you want? 1 lakh, right? You have only 30,000. You need a balance of 1 lakh. You will borrow 70,000 rupees, right? You will borrow 70,000. So your balance is 1 lakh. If you look at August, you are having the excess of 7 lakh rupees, right? What is the minimum balance you want to keep? 1. Right? So you will, 2 here, sir. Here you will keep 2. Because if you are having in excess of 2, you will keep 2. You will invest 5. Closing balance will be 2. So here the opening balance will be 2. Clear? Rest of the cash budget is simple. You just have to write what is the receipts, what is the payments. That's it. Only this one line was little bit of a trick. This point was a little bit of a trick, that if there is a shortage, then we will take only to the shortage so that we are able to maintain 1 lakh rupees. If it is in excess, we will keep 2 lakh rupees with us and invest everything rest. Right? So this is the first question, that is cash budget. Second question, following is the balance sheet of Exim Limited as on 31st of March 2024. So the balance sheet is given equity share capital, retained earnings, debentures and current liabilities. Fixed assets are given and current assets are given 30 lakh rupees. The additional information is given as under fixed cost per annum, that is exclusive of interest. That means it is talking about the fixed operating cost of 16 lakh rupees. Variable operating cost ratio is 70%. Total asset turnover ratio is 2.5. Income tax rate is 30%. Calculate EPS, operating leverage, financial leverage and combined leverage. This is a question from your module, sir. What will be the first step? For EPS, what is the first thing that we need? We need sales. How we can calculate sales? From this total assets turnover ratio, 2.5. Right. So what is total asset? Sales divided by total assets is equal to 2.5. Right. So total assets I'm having, sales I want to calculate. Sales will be total assets of 80 lakhs multiplied by 2.5. So 80 lakhs into 2.5, that comes to 2 crores. 2 crores of sales. Sales minus variable cost 70%. 1 crore 40 lakhs, you will get a contribution of 60 lakhs minus fixed cost of 16 lakhs, you will get 44 lakhs as what? EBIT. Right? From that EBIT, you will subtract interest 12.5%. Sir, how will you do it? Sales are, we have calculated 2 crores minus variable cost at the rate of 70%. Right? So it will be 1 crore 40 lakhs. You will get a contribution of 60 lakh rupees. From contribution, you will subtract your fixed operating cost. Fixed operating cost is given in the question as 16 lakh. So you will get here EBIT. EBIT will be 44 lakhs. From this EBIT, you will pay interest. Interest is how much? 12.5% on 40 lakhs. 12.5%, that is 50 lakhs. 5 lakhs, sir. 50 lakhs. 5 lakhs. You will get EBT, that is 39 lakhs. On this EBT, you will pay tax. Tax rate is given, sir. Tax rate is given 30%. Yes. 39 lakhs, 30% of it will be 11 lakh 70,000, right? So 27 lakh 30,000 will be your earnings after taxes. Any preference dividend, sir? Any preference holding? No, sir, no preference holding, right? This is your EAT divided by number of shares. What will be the number of shares that you will have? Sir, 20 lakh shares of rupees 100 each. So 20,000 shares. So what will be your EPS? 136.5. This should be your EPS. 136.5, sir. You just have to prepare this statement. Then can you calculate operating leverage, financial leverage? Yes, sir. Operating leverage will be what? Contribution divided by operating leverage will be 60 lakhs divided by 44 lakhs. 60 lakhs divided by 44 lakhs, that will come to 1.36, right? Financial leverage will be what? EBIT of 44 lakhs divided by EBT of 39 lakhs. Right, so 44 lakhs divided by 39 lakhs, that comes to 1.13. So what will be the combined leverage? That will be operating leverage into financial leverage, 1.36 multiplied by 1.13. 1.36 into 1.13. I'm rounding off to 2 decimals. 5368. Right, let's cross verify the answer. Yes, sir. I have rounded off to 2 decimal. 1.538. Fine, sir. Easy. You can round it off to 2 decimal, 3 decimals. That is absolutely fine, right? There is, if nothing is mentioned, you can round it off to 2 decimal or 3 decimal. Very easy question directly from your module, sir. Come to C part. The following information has been provided by LP Limited. Profit before tax is given 40 lakhs. Tax rate is given 30%. Equity share capital of rupees 10 each, 40 lakhs, that is 4 lakh shares. Return on investment is 18%. Cost of equity, that is KE, is given. This is R is given. Dividend payout ratio of 50%. Determine the price of the share as per the Walters model. So what is the formula for Walters model? That is dividend plus E minus D into R by KE whole divided by KE. All the information you are having. How will you calculate D and E? Sir, 40 lakh. On this 40 lakh, you will pay tax minus tax 30%. So 40 lakhs into 30%, that comes to 12 lakh rupees. So you will get earnings after taxes, or you will get residual earnings, right, of 28 lakhs divided by number of shares. Number of shares is 4 lakh. Right, so 28 lakh divided by 4 lakh, that comes to EPS comes to 7. Out of this, what is the dividend being distributed? That is 50%, that is 3.5. Yes, sir, dividend is 3.5. Now you can put it in the formula, that is P0 is equal to 3.5 plus EPS of 7 minus 3.5 into R is given 18%, KE is given 0.15 whole divided by 0.1. So this is what you have to solve and get the value of the price. Clear? Now you can solve it easily. Clear? Now the B part is, the second part is to determine the dividend payout ratio by applying the Walters model, assuming the price of equity share is 48. Now you have to calculate what is the dividend payout ratio. Right, this is again a question which you have done in the module. Price is 48, dividend you have to calculate, plus earnings is 7 minus dividend into 0.18 divided by 0.15 whole divided by 0.15. Now please be very careful with one thing here, that once you calculate the value of D, do not end the answer here. They are asking for the dividend payout ratio. You have to calculate dividend divided by payout ratio in percentage. You have to calculate, sir. Right? So C part we have done. Here we get the same thing, 51.33. Now once you have got the dividend, do not end the answer here. Dividend divided by EPS into 100. You have to show the ratio in the percentage terms, otherwise you are going to lose marks. Because what if, sir, we do not write DP ratio or the dividend payout ratio? Then you will lose the majority of the marks. The reason being, the requirement of the question you have not fulfilled. Clear? Right, sir? So question number 1 we are done with. Let's come to question number 2, A part. The following information pertains to CMC Limited. Number of equity shares are given 20 lakhs. Book value of 10% convertible debentures is 1 crore. Book value of 12% bank term loan is given 25 lakhs. Market price of equity share is given 55. Market value of 10% convertible debentures is given 108. Face value of equity share is given 10. Face value of 10% convertible debenture is 100. Beta coefficient is 1.5. Risk-free rate of return is 4.5%. Equity risk premium is given 9%. Rate of taxation 30%. The company expects that the share prices will rise in the future at an average rate of 6% per annum. Okay, sir. The 10% convertible debentures of rupees 100 each will be converted in 6 years time into equity shares of the company in the ratio of 1:4. That is 4 equity shares for each debenture. Convertible debentures point is here, right? The market value of the 12% bank term loan is at par. Calculate the equity share capital by CAPM. Obviously, sir, equity share capital by CAPM. What is the risk-free rate? Risk-free rate is given 4.5. 4.5 plus what is the beta coefficient? 1.5. 1.5 into 9 into 1.5 plus 4.5, that comes to 18. KE comes to 18%, sir. Right? Very simple. This is free fund marks, sir. Free fund 1 marks. Second part, the cost of convertible debentures using the approximation method. Now this is going to be interesting. Regarding the convertible debentures, it is how much is the period, sir? The period is 6 years, isn't it? The period mentioned here is 6 years. 0, 1, 2, 3, 4, 5 and 6. So rest everything you have regarding the debentures. The only thing is the redemption value that you have to calculate. Redemption value is either the debentures or the equity shares. For equity shares, you will have to calculate what will be the value of equity share. What is the value of equity share right now? The value of equity share right now is 55 rupees and the growth is expected at 6%. So here the price is 55 rupees. Here the price is 55 rupees, sir. It will grow every year at 6%, 6%, 6%. So you have to find out what will be the price here, right? So if we apply 55 plus 6%, here it will be 58.3. Here it will be 61.798 plus 6%. Here it will be 65.5051. Okay. I'll just round it off now. 65.51 plus 6%. It will be 69.44. 69.44 plus 6% will be 73.61. 73.61 plus 6% will be, here it will be 78.03. Right? So for every 1 share, it will be 78.03. Now he will get 4 shares. So 4 into 78.03. It will be 312.12. I have rounded off, so it can create a little bit of a variation. Right? So for convertible debentures, yes, sir, 312.07. I have rounded it off to 2 decimals, so 312.12, absolutely fine, right? So price is this, net proceed is 108, that is market value, or 100. Market value will take 108. N is 6 years. Interest is there. Tax, please do not forget to take the tax impact. Please do not commit this kind of a mistake. So KD you will get. Bank term, simple sir, I into 1 minus T. I into 1 minus T. That is simple. Then weighted average cost of capital using the market value weights that you can do, sir. Market values are given. Number of equity shares are given. Right, multiplied with the market value, you will get the market value of equity shares. Then for the debentures, number of debentures into the market value of the debentures 108. This you can do, sir. It is 1 crore divided by 100. You will get the number of debentures, right? So from there, divided by 100, cut do 1 lakh debentures will be there. So 1 lakh debentures into 108 market value of the debenture you will get. And for the term loan, it is going to be 25 lakhs only. For bank term loan, there is no market value separately, sir. Right? Equity share capital, convertible debentures. For bank term loan, there is no separate market value. So you have to take whatever is the book value, that is 25 lakh. Right? So now you can calculate market value weights. Easy one. Right? Just this convertible part, you have to do it very carefully. Rest everything is easy. Okay. Come to the next part. The following information pertains to the MSD Limited for the year ending 31st of March. Raw material storage period is given, that is R. Work in progress conversion period is given, that is W. Finished goods storage period, that is F, is given to you. Debt collection period, that is D, is given to you. Creditors payment period, that is C, is given to you. Total annual operating cost including depreciation was 60 lakh. Assume 360 days in a year. Calculate the operating cycle, sir. What question, sir? Operating cycle is what? R plus W plus F plus D minus C. 61 plus 20 plus 30 plus 45 minus 60. So how much? 61 plus 20 plus 30 plus 45 minus 60. 96. Number of operating cycles, sir. 360 divided by 96. 3.75. Sir, amount of working capital required for the company. Amount of working capital required for the company. Sir, 60 lakh is the total annual operating cost. Out of that, 4,80,000 depreciation I will remove. Because in case of depreciation, there is no actual investment done. So working capital is not required for the depreciation. Divided by 3.75. 60 lakhs minus 4,80,000 divided by 3.75. That comes to 14,72,000. Amount of working capital required. Sir, just a 3 minute question. That's it. Question number 2, B part done. Let's move to the next one. Question number 3. Let's see. Question number 3. Investment decisions. Let's come to question number 3. Capital budgeting. SRT Limited manufactures the steel rods and is now considering to purchase a new aluminium smelting and molding plant. This plant will have the cost of 20 lakhs to purchase and install, having a useful life of 5 years with a residual value of 1 lakh rupees. The production and sales from the new plant are expected to be 1 lakh units per year. Other estimates are follows. Selling price is given, direct cost is given. Now, sale units, selling price, direct cost. This is all for the statement of CFAT. Fixed cost, including a depreciation, is 8 lakhs per annum. Can you tell me what will be the depreciation, sir? Can you tell me what will be the depreciation here? The depreciation will be 20 lakhs is the cost minus the scrap value of how much? 1 lakh divided by useful life of 5 years. That is 19 lakh by 5. 3,80,000. 3,80,000 will be the depreciation. So out of this 3,80,000 is your depreciation. Sir, why we need depreciation separately? Because we will add back while calculating the CFAT. Marketing and promotion cost not included in the above will be 1 lakh and 1,60,000 for the years number 1 and 2 respectively. So in the first 2 years, there will be a marketing and promotion cost. Additionally, the investment in the debtors and stock will increase in the year 1 by 1,50,000 and 2 lakh respectively. The creditors will also increase by 1 lakh in year 1. Thus, the debtor stock and creditors will be recouped at the end of the 5th year. Now, this is what, sir? How will you take debtors, stock, creditors? What it's talking about? Sir, current assets, current liabilities. What is current asset, current liabilities? Anything in the capital budgeting talking about current asset and current liabilities? Yes, sir. It is working capital. So what will be the working capital required here? Working capital required here is 1,50,000 plus 2 lakh minus the creditors of 1 lakh. So this will be 2,50,000 of working capital which will be there. Right now, how to interpret it? There are two interpretations. He says investment will increase in the year 1 by this, and so two things are there. Either we take this working capital at 0 period, that in the year 1 we will require, so we will issue it at 0 period, or the alternative assumption that you can make is the working capital is required at the end of the first period. Both the alternatives are correct. This is basically the interpretation. Increase in the first year means there will be a requirement in the first year, so we can issue it at 0 period also, or we can say during the first year the requirement arose and we issued it at the end of the first year. So both ways it is absolutely correct. Clear? Even the solution is given both the ways. The cost of capital is 18%, corporate tax rate is 30%, and is paid in the year in which the profits are made. The depreciation is tax deductible. Calculate the NPV and PI. Advise which plant should be taken. The present value factors are given to you. Is it difficult, sir? Simple. You have to prepare a statement of CFAT, right? For that, the sales are there. See, sales are there. Right, sale units and selling price is given. For cost, direct cost is given 100 per unit. Marketing cost will be taken only in year 1 and 2. Depreciation will be given, right? Other fixed cost, that out of 8 lakh, 3,80,000 is your depreciation. The remaining 4,20,000 is your fixed cost. Total cost you will get profit before tax, right? Tax, deduct the tax, you will get profit after tax. Then add back depreciation, you will get the cash flows after tax. Add back working capital released. Working capital will be released at the end of the period because nothing is mentioned. So we are assuming it at the end of the period. 2,50,000 release of working capital, and the residual value of the machine will also be there, 1 lakh. So net cash flows will be this. Calculate the present value less the initial cash outflow. Initial cash outflow will be how much? 20 lakhs cost of machinery plus 2,50,000 of working capital, if we assume that working capital is being released at 0 period, right? So you will get NPV here, sir. Sir, presentation, you can do it in your own way. That is totally fine. This is also a very good presentation. If you want to do it in the way I have prepared the NPV statements and all, that is your choice, right? Presentation totally fine in any way. Statement of CFAT separately you can prepare, then statement of NPV separately you can prepare. That is totally your choice. Clear? So PI you can calculate now. PI is sum of present value of cash inflows divided by sum of present value of cash outflows. Then you have to advise. Very easy and simple question on capital budgeting. Nothing can be easier than this. B part of the question, last part. The equity share capital of Sky Pack Limited as on 31st of March 2024 was 2 lakh. The relevant ratios of the company are as follows. Current debt to total debt is 0.35. Total debt to owner's equity is 0.65. The fixed assets to owner's equity is 0.55. Total asset turnover is 2.5 and inventory turnover ratio of 10 times. You are required to prepare the balance sheet. In the balance sheet, what all things you will take, sir? If you talk about the balance sheet here, the balance sheet will look like something this. The balance sheet will not have much of items, you know. The balance sheet will not have much of items. The only few things that it will have is one, equity share capital, right? Then it will have what, sir? Long-term debt. Then it will have long-term debt. Then it will have current debt, that is current liabilities it will have, right? On this side, it will have fixed assets, and in the current assets, it will have inventory, sir. It will have inventory because inventory turnover ratio is given, and then other current assets might be there. How to solve this now? See what is given to you. You are given the equity share capital is 2 lakh rupees. Now this 2 lakh rupees is given to you. Using this, what you can calculate? You can calculate total debt to owner's equity. Yes, 0.65. So total debt to equity is equal to 0.65. So from here, what will be total debt? That will be 2 lakh multiplied by 0.65. 2 lakh, 1,30,000. Now total debt is what? This 1,30,000 will have long-term debt and current debt. Now how can we bifurcate? See here, current debt to total debt is 0.35. Current debt is 0.35 of total debt. Total debt is 1,30,000. 45,500. Right? So 1,30,000 minus 45,500, 84,500 will be long-term debt, right? So long-term debt is 84,500 and here current debt is 45,500. So what is your total liabilities from here? Plus 45,500 plus 2 lakh, 3,30,000 will be your total liabilities and total assets will be 3,30,000. Now next, fixed assets to owner's equity. Okay sir, fixed assets will be how much? Fixed assets will be 0.55 of the equity, that is 0.55 into 2 lakhs. Right, so 2 lakhs multiplied by 0.55, that comes to 1,10,000. Right, so out of 3,30,000, the current assets will be how much? 2,20,000. Out of this we can calculate inventory, I guess. Yes sir. Total assets turnover ratio. From this total assets turnover ratio we can calculate what? Sales. Sales is equal to 2.5 times of the total asset. Total asset is 3,30,000. Right, so 3,30,000 into 2.5, that comes to 82,50,000. Will no sir, 8,25,000. Sorry, it will be 8,25,000. This will be your sales, and the inventory turnover ratio is given. Inventory turnover ratio can be calculated on sales also, sir. 8,25,000 divided by inventory will be equal to 10. So inventory will be how much? Inventory will be 82,500. So inventory will be 82,500. So what will be the other current assets? 1,37,500. Balance sheet complete, sir. This is how the balance sheet will be prepared. And all the workings you have to show, all these workings, how you are calculating, all these you have to show in detail, right? Let's check the balance sheet once. Yes sir, correct. See here, right? Very easy part. So fourth is just your theory part, just go through with it, and with this we are done with this January 25 paper. And I hope all the papers till now, whatever we have done, you have an absolute clarity on this, and you must have got the feel of how the papers institute has been asking, and that will give you the confidence for your upcoming attempt, right? So all the best for your exams, guys. All the best for your preparation. See you guys in the next video. Till then, stay safe, stay healthy, keep studying, keep sharing. Thank you so much.